it's very hot or whether it's a little bit cooler than people are currently pricing in?
Well, it's all about the consumer. It's all about the labor market. It's all about incomes. So what we are seeing right now is the effect of what has happened so far. And what we have to consider is that we started the third quarter on a very high base. So even if we had very little progression, we would have still seen a very strong growth rate, which we expect to see now. Now, what happens beyond that is a very different thing. We saw a huge deceleration last year because when fiscal measures expired. But this time around, we'll be in a different situation, hopefully, because the labor market will have made progress, and we have made huge progress on the health front. So while there's a lot of uncertainty, our focus remains on the labor market because we think that is the Fed's focus as well. They would rather tolerate a little bit of inflation for a little bit of better outcome on the labor market.
I mean, Rubeela, I know you don't want to talk about this, but, I don't want to get you in the Carl Weinberg timeout chair. Let's link Carl's work together with your work, and that is the trade deficit, the fiscal deficit as well. Do you see any relief there, or do you just assume an expanding trade deficit to GDP, a stable or expanding fiscal deficit to GDP?
Well, if you think about the trade deficit right now, what we are seeing are imbalances, right? I mean, the U.S. economy is open, the European economy is getting there, not quite there. So therefore, you have, goods deficit in the record. I do expect some adjustment back as other economies reopen. So I don't expect that this trade deficit issue is going to be, it's just going to persist. I do think we're going to see adjustments, but on the deficit side, budget deficit side, I do think that what happens with these negotiations is very important. And especially when we look at, the Biden administration's push that this is not going to be a deficit finance, this is going to be, this is going to be paid for. So, there's a lot of uncertainty, but I do think that we could come out on the other side of this, maybe not as in bad a situation as a lot of people are expecting.
Rubeela, before we let you go, we're about 2 hours away from the initial jobless claims that we get every week. Increasingly, they are going down, and yet people say that they're very noisy and markets tend not to trade off them. Are they basically useless as any kind of indicator at this point?
It's really, I mean, we still follow it, but there, like you said, there is a lot of noise in the data. It's really surprising. It's puzzling why we would see 400,000 people get laid off each week, these filings. What we are looking at is the continuing claims number. They are also, extremely high, but we do see value in it, in terms of, it's a high frequency indicator, but I do play less weight on it because of the fact that it doesn't really seem to be connecting right now with what's happening with the economy.
Rubeela Faruqi of High Frequency Economics, the chief US economist. We've got to leave it there and turn to the biggest news story of the morning and cross over to Bloomberg's Maria Tadeo. Maria, great to catch up. There is a merry-go-round beginning in European football. Can you walk us through it?
Yeah, it's the summer season. It's the summer mercato that's really kicking off in Europe for players and coaches. And today, of course, we have Zidane that's leaving Real Madrid. For me, I'm Spanish. I'm a huge fan for Real Madrid. So this is a huge shock personally, but also it's a big thing for football because we're going to see players and trainers also moving around. For Real Madrid, of course, this is not a good season. As you know, there was no Champions League, there was no league, there was no Copa del Rey, and Real Madrid is a team where you need to win titles, otherwise you're out.
I mean, Maria, I love how you put it. No Liga, no Champions, no Copacabana. I've really read in on this as best as I can. And Maria, what I see here is Zidane. Even I know who Zidane is. Why can't he coach in England?
Maybe, well, he could go if he wanted to. It's very different to Real Madrid. It's probably also very different to the French style that he's used to. And he was a player for Real Madrid and also a player for the French national squad. He could go to the UK. I mean, that's potentially an option. But I would argue it's not the most natural fit.
I was hopeful that he'd reunite with Juventus, but that doesn't seem to be happening because the reports coming out of Italy this morning suggesting that Max Allegri
you guys are taking
is going
this seriously.
back. So I'm taking it seriously so we can do it. Just let me finish just quickly. Juve stock up by 2% this morning. That gives us clearance, Tom. Carry on.
Okay, John, why can't Zidane go to the Tots? It's that simple.
I don't know if that's a prestigious enough club for him.
Really?
Seriously? What could be interesting if Pochettino left PSG and went back to Spurs, and then that opened the door for Zidane at PSG. Do we know, Maria, if Zidane wants another management job?
Look, I think what's interesting, John, here, on a serious note, is that Real Madrid makes it very clear this was his wish. It was not Real Madrid asking him to leave after a bad season. He wanted to go. So that potentially would open the door for going back to France, if that's what you're hinting at. But this was a decision that Real Madrid makes clear was his choice. It was not Real Madrid ousting him.
Maria, thank you. Maria Tadeo, thank you for indulging us. Tom, we've got to take this a little bit seriously, and then we get to do it again. And again and repeatedly. Juve stock up by 2% this morning. Big move.
Yeah, well, it's a big move, and frankly, it's all part of it. But John, we're in the season. I get it, but it's different now because the money's not there like it was pre-pandemic.
Well, Antonio Conte left Inter Milan for the same reason. Tom, the money's not there in the same way, and he had a bit of a falling out with the club over that issue. It's going to be interesting to see how much money these new coaches get to spend when they arrive at these new clubs.
Yeah, we are scrupulous about our mistakes, and I've got to run this correction right now. And I must say that this is completely my fault. John, it's Copa del Rey, not Copa.
I like the way you did that, Tom. I like the way you did that. I thought it was just a play on words.
I don't know.
That was a genuine mistake.
I'm just trying. I'm trying. All I know is the Padres are rocking it, and the Red Sox are keeping up.
I appreciate how hard you're trying. Coming up, Dr. Jennifer Nuzzo.
Copa del Rey.
John's.
He's at least trying.
Copa del Rey.
I don't even have anything.
Lisa, you were really strong in that
Thanks,
segment.
I appreciate that. I know
Lisa
that Zidane is Zizou, right?
Jonathan Ferro,
Isn't
you
that-
are right.
Wow, look
There
at
you
that.
go. 41.83 on the
Copa
S&P.
del Rey.
We're down 9 on the S&P.
I love when
Down
we were there,
0.2%. There
John
is
is
so
so
much
I was
going
there in
on.
March.
Yields up a basis point, 158.75. Stay
I'll
tuned
break
for
into
more.
my Barry Manilow. Da, 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 da,
This is the
da.
promo for this show.
Then we're in
Come on.
trouble.
From New York City, for our audience worldwide, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The Biden administration is taking steps to prevent ransomware hacks like the one that crippled Colonial Pipeline earlier this month. Directives will be issued as soon as today, requiring pipeline operators to conduct cybersecurity assessments and report any incidents to federal officials. Companies could face penalties starting at $7,000 a day if they don't comply. Turkish President Recep Erdogan is facing growing calls, even some from within his own ruling party, to launch an investigation into corruption allegations made against powerful members of his inner circle. The claims were raised in a series of YouTube videos that have attracted more than 50 million views in recent weeks. Erdogan has voiced his unconditional support for his allies. Taiwan's government says it plans to double a proposed increase in stimulus funding to more than $22 billion. As the island's economy reels from tightening virus restrictions, authorities are under pressure to move quickly after an explosion in COVID-19 cases. The island has already issued subsidies for industries and cash vouchers for more than 98% of the island's residents. And Airbus plans to ramp up production of its best-selling A320 series beyond pre-pandemic levels within 2 years. The world's biggest producer of commercial jetliners is telling suppliers to be ready to raise output of its top-selling narrow body to a rate of 64 per month by the second quarter of 2023. And Airbus says that could climb to 75% or 75 per month by 2025. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
System, to be perfectly frank. I think I'm nervous about being out in public as an individual where so many people in certain places aren't vaccinated, and we don't have a way of enforcing vaccination. We don't have a way of even documenting vaccination in a meaningful way.
That was Lauren Sauer there, the Johns Hopkins Associate Professor of Emergency Medicine from New York this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Economic data, 8:30 Eastern Time. Before we get there, your market unmoved, unchanged. On the bond market, yields are up 1 basis point to 158.58. A little bit of anticipation as I build up to the big moment. Equities are down 8 points, down by 0.2%, Tom. Euro dollar, 122.05, up around 0.1%. And WTI, 65.67, down around 0.8%. Just big moves this Thursday morning.
I noticed the VIX through 17.89 as well. We do housekeeping here, and we're really scrupulous on our corrections. And we had an intern, they just misspelled this, but very important on Copa del Rey with Maria Tadeo and Real Madrid and the failure there and all going on. We had Copacabana, and as Michael McKee points out, thank you, Michael McKee, for being on top of this story. This is embarrassing.
It
I do point out the intern is
You mean that we're doing this, the correction, or the actual thing?
This intern is just gone. I mean, it was a complete failure. Right now, we get back to the serious nature of this pandemic, and I'm going to go personal last night. I had dinner last night with a woman fully vaccinated. Jennifer Nuzzo joins us from Johns Hopkins, and Jennifer, the fully vaccinated person, was scared stiff of going indoors in a restaurant. There's a lot of trauma out there. It's like serious psychiatric realities we're dealing with. What's a psychiatric reality you're focused on right now of the vaccinated, and for that part, the unvaccinated?
Yeah, well, first of all, I understand that hesitation that everyone has. We had to upend our lives and learn new ways of living for the last year. So I think for a lot of people, it's going to be hard just to flip the switch and go back and to even remember what that was. I was once talking to a psychologist who likened it like getting a cast taken off. If you've ever had that happen, you see that, your arm is atrophied a bit, the skin is a bit pale. So it takes time to build back those muscles to going back to being out, we've been so, scared about restaurants for so long in particular. So I think it's going to take some time for people to adjust. That said, I am still most worried about the people who aren't vaccinated and, want to focus on reaching them and talking about how it does enable a path back to those activities. And even if they're still doing it right now, it allows them to do it without any worries whatsoever.
Doctor, are we worried about them or worried about us because of them? There is a difference. Which one is it?
I'm worried about them. I mean, if you're vaccinated, I don't worry about you. You're protected. The likelihood that you could get infected from them is incredibly low. And then the likelihood that even if you were in some slim chances, and there is a slim chance,
because
but
that's important,
incredibly
Doctor.
low.
That note is really important. When I say us, I don't just mean me. I mean the healthcare system, all of us in it together. That was the story of 12 months ago. If it's just about them now, isn't that about their own personal risk and their risk tolerance and what they choose to decide to do?
Yeah, I'm not as worried about the health system becoming overwhelmed again. I mean, first of all, the best thing that we could have done was vaccinate people over the age of 65 because we know that's the biggest risk factor. Vaccinating nursing homes, which have contributed to about a third of the deaths that we've seen. So we do have some good protection, but I don't want there to be any additional loss of life at this point. And so I'm really interested in making sure we have a vaccine to protect people. And I just want people to understand how liberating these vaccines are.
So you recently just were fully vaccinated. Do you go out to eat? Do you not wear a mask? And do you feel totally safe?
So I haven't yet gone out to eat because I've been busy, but I would. I absolutely would. I would probably still, because I've got young kids, choose well-ventilated places, and I would probably still, because the weather allows it now, try to eat outside if I can. But again, not for me and my husband, but for our children. In terms of masks, I actually find that it's a little bit trickier, in part because, the norms haven't fully changed. Where I live, a lot of people aren't wearing masks, but some are. My kids have to wear masks when they're out. So I sort of try to read the vibe of the place. And if I feel like my not wearing a mask is going to bother people, including my children, I will wear one.
Okay, but this is actually kind of important, this idea that it's become a social token in a way, to wear a mask for people who are vaccinated more than anything that actually does something. Is that correct?
Oh, yeah. I mean, to be clear, I am wearing it more because I don't want to make people uncomfortable than I'm wearing it because I'm trying to protect myself.
Jennifer, we're opening up. I mean, we can feel it each and every day. You can feel it in New York. It's really, really tangible as well. What's your timeline back to normal? Is it September or is it a mystery?
Yeah, I mean, I have expected that this summer is going to feel a lot more normal. So to those people who are scared right now, I think over the next few months, they'll start to feel less scared because they'll just see things changing around them and it will start to feel less scary. I think the fall is still looking good in my projections. That said, we always worry that when the weather gets cooler and people start heading indoors more, that in places where there is not great vaccine coverage, we could see outbreaks. So if you're living in one of those places where you think most of your neighbors and community members are not vaccinated, then maybe you have a few more worries heading into the fall. But I don't think we're ever going to go back to those hideous numbers that we saw last winter. That's really thanks to the vaccines.
Dr. Jennifer Newso there of Johns Hopkins Center for Health Security, senior scholar over there. Doctor, always fantastic to have you with us on the program. Thank you. And Lisa, blurring the lines a little bit here between science and social etiquette. It's now become about social etiquette and not so much about the science.
Yeah, that basically you don't want to signal that you're on the other side of science, and so that's why you wear a mask. Also, the idea that
that doesn't even make sense, does it?
Well, the idea here is we can't really tell who's gotten vaccinated and who hasn't. It's not like you've got a badge.
Just said it's up to them, isn't it?
Correct, but I think that a lot of people want to signal their support for mask wearing. I understand what you're saying, and yet it has become more of a social issue in some capacities than a scientific one.
I do wonder how we'll look back on these conversations, Tom, in years to come.
Well, we're going to look back on it. I think the analog to the pandemic of 1919 is apt and true. I mean, we're going to see a boom economy. There's going to be an effervescence and the then what? Just in the zeitgeist yesterday is the idea of, will there be a permanence to the vaccination of COVID? Will it be like the flu? Will it be like other ideas? You wonder, to your point, John, where are we not in 2 years or 1 year? Where are we in 5 years on this?
When you ask the science community, are we worried about them, those who haven't been vaccinated, because we are worried about them, or are we worried about them because we're worried about us? And there's an important distinction there. People make stupid decisions every day, and guess what? They don't think they're stupid decisions at the time they make them, and maybe they don't think not getting a vaccine is a stupid decision. Maybe they think that's a fine decision to make. But ultimately, Tom, if that is now their risk and their risk alone, and no longer the risk that we all have to bear, then I think we have to move away from this pretty quickly and change the messaging.
Well, you're going to see it in the next couple of weeks. I don't know how you get a baseball park. We were making jokes about it yesterday. Padres, Mets, June 12th. That looks great, Lisa.
Thanks.
But, you know, the idea of as you build out those attendances, what happens? We don't know. I'm sorry, we don't.
Brian Levitt, Invesco Global Market Strategist. I'll keep listening to the people that know what they're talking about. And when they start talking about social etiquette and no longer the science, gets your attention a little bit more, doesn't it? The S&P 4184, we're down 0.2%. From New York, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
The economy is rip-roaring. And this is the quarter where we will transition from recovery to expansion.
In this scenario, where you've got consumers sitting on $3 trillion in extra savings. Banks can't lend the money out because people don't need to borrow it.
We're looking for a slowing rate of equity gains. There's definitely some storm clouds that we're concerned about.
I don't think that's going to be enough to force the Fed's hand into tightening any time before 2024.
People are vaccinated and they're still not ready to get up and go and do things the way they did them before.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
90 minutes away from the data in America, from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures down 8 on the S&P 500. We declined by a couple of tenths of 1%. The data, Tom Keene, 8:30 Eastern time. We're looking for a continued improvement in claims.
Well, the continued improvement is there. As I mentioned with Lisa in the last hour, folks, it's real simple. Line up all the charts we have, and there's a mathematics to them, whether the y-axis is arithmetic or logarithmic. John, it is the most elegant trend I have in hundreds and hundreds and hundreds of charts. Claims every week is on a great trend to improve.
And Tom, we want to see more of the same going into a payrolls report just 2 Fridays away.
Well, yeah, the payroll, this is, John, it's the first time we've talked about this.
We can talk about it
now. And all
now.
of a sudden, it's upon us as well. And, of course, 2 weeks after that, you've got the Fed meeting as well. The payrolls report has to deliver after, remember the shock of 2 weeks ago?
620, that's the estimate. Feels like 2 weeks ago. 620,000, I think it was 2 weeks ago.
That's good, you nailed that, John.
2 weeks and change. Thanks,
Yeah,
Tom.
thank you.
620,000 is your median estimate from that big downside surprise, Lisa, in a previous month of 266.
Yeah, the question I have is which data point's going to actually be most relevant at this point? Because a lot of data comes out, it beats, it misses, people shrug. It isn't hugely market moving. Tomorrow, however, we're going to be getting personal income and personal spending data, the PCE inventory ideas. I am curious about that. I feel like that is where it matters. How much of the cash are people spending in real time? And I wonder how much more weight that has even than the jobs number at this point, John.
How much savings come down, Lisa?
Yeah.
That has got to be the key variable.
Absolutely.
For economists looking out a year.
Yeah, they have this incredible cash glut in their savings accounts. Tom, you keep talking about it with respect to banks trying to park cash with the Federal Reserve. Now the question is, how quickly are they going to spend it?
You guys have touched upon, to me, the biggest issue out there, John, the quality, the behavioral makeup of all that cash that's out there. How much of it's going to be spent? How much is going to go into various forms of market? And how much of it is just a lead weight that will never move?
We don't know.
Yeah.
And we don't know.
Huge question.
Your range going into payrolls next week, by the way, the high estimate so far, 925,000. The low, 335,000. It's quite a range. Your average, 627.
And all the economists from the last time around are still employed, right?
Yeah, they're kind of doing that this morning. The good news for a lot of those economists is that they're all on the same page, Tom, looking for something in and around a million. Many of them were anyway. Your equity market this Thursday morning down about 8 on the S&P 500. We come in 0.2%. In the bond market, yields are higher by a basis point to 158.75 euro dollar. Back with a 122 handle, Lisa, up 0.11%. That is a slightly stronger euro.
It's absolutely a shockingly interesting market today. And you start to wonder at what point the data will start to make it even more interesting. 8:30 a.m., as John was saying, we do get that slew of data. People are looking at the U.S. initial jobless claims. They are incredibly noisy. Nonetheless, that elegant trend that Tom has been talking about is what we are looking for in a continuing downdraft in terms of the number of initial jobless claims. Also, first quarter GDP coming out in April, durable goods orders. Both of those may actually offer more insight into the economy in a predictable way, although still, I'm looking for which data points really matter most. 1 p.m., the dreaded 7-year sale, $62 billion auction of 7-year notes by the U.S. Treasury. Question is, will there be any pushback? There has not been so far for the 2-year and 5-year auctions earlier in the week. And 2:20 p.m., President Biden is delivering a speech on the economy. In Cleveland, Ohio, how much will he budge? How much will he give in to Republican proposals for a roughly $1 trillion infrastructure spending plan that redefines infrastructure away from social plans back to bridges and roads, John?
And Lisa, thank you. We'll head down to D.C. in 20 minutes on this program. Here's a note for you. It's still early cycle. That favors credit over treasuries, stocks over bonds, cyclicals over defensives. I expect this cycle to play out over a multi-year period. Brian Levitt of Invesco, the global market strategist, joins us now. Brian, that first piece, it's still early cycle. That favors credit over treasuries, stocks over bonds, cyclicals over defensive. That was basically the outlook coming into 2021. Some people have started to move on. They've said this cycle has moved so fast. You still see it as early cycle 1, and you expect this to play out over a multi-year period. Why, Brian?
Right, and so that story has played out well. I think what investors need to differentiate between is, first, where are we in the cycle? Second, what's the direction of the economy? And so when I talk about cycle, I mean, we've seen cycles play out in the United States on average something like 7 years. The last cycle was 10 years and probably would have continued had it not been for the coronavirus outbreak. So the cycle continues. The story on the direction of the economy is one that moves more from the recovery phase of a cycle into more of the expansion phase of the cycle. And there's some implications for markets as a result of that. But the cycle will continue until we build massive excess, until there's big inflation, until the Fed has to raise rates multiple times. I know investors are worried about that. I think it's premature.
Brian, just simply, where are we on international investments? 6 months ago, 8 months ago, it was gospel. Everything was rocking, international to the moon. That all collapsed. EM really didn't do all that well. How do we reframe now to allocate now to international investment?
Yeah, it makes sense. I mean, you see the dollar had a little bit of a leg up when there was a lot of concern a few months ago that the Fed was going to have to tighten early. Some of those concerns have started to come out of the market. The dollar has been weakening. That provides a nice tailwind to non-US dollar assets for US dollar investors. Valuations are more attractive. You're seeing European equities performing well as vaccine rollouts improve. They're not to the extent they are here in the United States, but improve there. I mean, the emerging markets still have some challenges in this vaccine rollout. As we all know, places like Brazil and India still struggling under the weight of the coronavirus. But there are companies, really good companies in the emerging markets that are trading at more attractive valuations, have good growth prospects. So investors, I would suggest, don't go out and buy broad indices, but be selective in the emerging markets where valuations look good, growth prospects are good, and if the Fed continues to remain on hold, we should be in a stable or perhaps even weaker dollar environment.
Brian, where's the biggest risk right now?
I still think the biggest risk is on the inflation story. I mean, last time I was on, Jonathan said we can't say transitory anymore, so I used the thesaurus to say temporary or momentary or however we want to categorize it. But that's the risk, in my opinion, is that you get some inflation data. I don't think it's the end of the cycle inflation data, but I think what you'll see as that happens is a tightening of financial conditions in the market, which could bring about an equity market correction. Now, I would view that equity market correction as a buying opportunity. They tend to happen any year, most years anyway, usually because of policy uncertainty. So I suspect that'll happen at some point. But to me, that is not the end of this cycle.
So what you're describing to me, I do wonder why you don't just do a massive barbell, to have some treasuries, some cash, and then just go as risky as you possibly can, because that's what you expect to do best. I mean, is that the type of portfolio that you see outperforming going forward?
I think investors should be exposed to risk assets. And, you know, in the early stages of a cycle, you want to be more value oriented. You want to be more small and mid cap. And we've seen that perform very well. As you start to move into an expansion, growth stocks start to participate more. So it becomes a value and growth story. Credit goes from being the big outperformer to being more of a coupon return-like asset. You know, treasuries, yeah, they can protect you in a bout of volatility, but in an expansion phase in a cycle, if you're looking for absolute returns, treasuries are not an ideal place to be because rates should move somewhat higher. So yeah, if you're looking to manage risk, then obviously you want to be in core bond-like securities. But if you're looking for what's going to be the big outperformers, again, I continue to expect it to be the equity market, really value stocks and growth stocks.
Brian, got to leave it there. Got to catch up, sir. Brian Levitt there, Invesco Global Market Strategist. Got to turn to the FX market. Cable breaking out a little bit, up 0.25%. That's the pound against the dollar, 141.55. Gordon Vliga of the Bank of England on the MPC over there, voting member, goes on to say that hikes might come likely well into 2022 in the central scenario. Goes on to say that an early rate hike is possible if we get a smooth transition from some of these labour support programmes in the UK. Cable, pound just a bit stronger, 141.56.
Nice chart.
What's interesting here, Tom, is just the subtle shifts you're seeing at places like the Bank of England, like in Canada, like in New Zealand, in ways that you don't get over at the Federal Reserve. Just these subtle shifts, and they have a little bit of a hawkish flavour. I also think it's worth pointing out, as Nordea has done recently as well when it comes to the Bank of England, we didn't have a significant period of undershooting the inflation target in the UK in the same way that the Federal Reserve has done one and the ECB has done two. And I wonder what that means for the Bank of England for the years to come.
I would suggest whether it's ECB or Fed June 16th or the Bank of England and Ballet John, they're literally making it up as they go. None of this, folks, is in any of the textbook, the fancy suits and ties and dresses study.
Vliga going on to say, Lisa, inflation comparisons with the 1970s are, quote, misplaced.
What's interesting to me is that a lot of these global central banks, aside from the Federal Reserve, seem really concerned about financial stability. And they are citing that increasingly as a reason for looking at possibly raising rates sooner than later. And the Federal Reserve does not seem worried at all. I mean, a little bit on the margins, but non-voting members, everybody else says everything is contained.
Well, it's just two issues for them, isn't it? They'll talk about financial conditions as if it's exclusive from what is happening elsewhere.
It could be related,
policy.
Jay Powell has said.
Could be related.
It could be related, but not necessarily. You buying that?
It's not for me to buy it, is it? They've got to work that one out. Sounds pretty ridiculous, though, doesn't it? To say on the one hand that this is happening, and on the other hand, we're doing this, but it hasn't got anything to do with what's happening over here.
Right, and that's actually what other central banks are trying to say. Tom, you buying that? I don't know.
I'm just listening in fascination.
Yeah, no, honestly. I mean, look, the Federal Reserve indisputably has affected financial conditions, loosened them, and caused a lot of money to flow into much riskier parts of the market.
That move on sterling from 141.12 to 141.61, a move of 1/3 of 1%, is the most interesting thing that's happened in the last hour. Coming up, 8 a.m. Eastern Time. Peter Cheer, Academy Securities Head of Macro Strategy. Look, if you think I'm joking, I'm really not. And if you're waking up thinking today's going to be a busy day, it really isn't so far. Yields are up a basis point at the moment. We might get back to 160 on 10s, 159. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. The Biden administration is taking steps to prevent ransomware hacks like the one that crippled Colonial Pipeline earlier this month. The directives will be issued as soon as today, requiring pipeline operators to conduct cybersecurity assessments and report any incidents to federal officials. Companies could face penalties starting at $7,000 a day if they don't comply. ExxonMobil CEO Darren Woods has been dealt a stunning defeat by shareholders. A tiny activist investment firm snagged at least 2 board seats and promised to push the crude driller to diversify beyond oil and fight climate change. It was the latest setback for Woods. The oil giant, once the world's most valuable company, has shed more than $125 billion in market value during his tenure. And Thailand's capital, Bangkok, is opening registration for COVID-19 vaccines to millions of residents today. The government is expanding vaccine eligibility to everyone 18 and older. Thailand reported more than 3,300 new cases today, with 47 deaths. That's the highest single-day increase since the pandemic began. Total cases have more than quadrupled since April the 1st. The U.S. Justice Department is opening a probe into the meltdown of Bill Hwang's Archegos Capital Management in March. The blow-up left big banks in Europe, Asia, and the U.S. with more than $10 billion in losses. Sources tell Bloomberg federal prosecutors in Manhattan sent requests for information to at least some of the banks that dealt with the firm. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York, for our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro, live on radio and TV. Your equity market down 7 on the S&P 500, down 0.16%. Your yield on a 10-year up almost 2 basis points to 159.26. Euro dollar, stronger euro here, 122.07. Stronger pound in the mix as well, heading back towards 142 on cable. Gert-Jan Vlieger of the MPC on the Bank of England having a little bit of a flirt with a further interest rate move, maybe in early 2022, with a big maybe on top of that. Then goes on to say not many rate hikes are necessary to slow the economy. And isn't that just the issue? Regardless of timing, Tom, you get back to neutral pretty quickly in this world.
This is so important observation, and I saw on the Zeitgeist yesterday, I'll give credit to Zero Hedge, but it could have been somewhere else. There was a photograph of Arthur Burns from long ago, and John, this is what Greenspan codified. Go measured, and you can have a big impact quicker than you think.
Yep, go early is one thing. How far can you go? That journey, how long is that journey once you begin it? Yeah, I agree.
Because Arthur Burns, folks, was raising by 3/8 and 5/8 or whatever the numbers are, and Greenspan codified that quarter-point move, which is maybe our modern central banking. Right now, it is a joy to get perspective from Wendy Benjaminson, Bloomberg Politics editor with truly an understanding of the cadence of conservatives and liberals in Washington. Wendy, we have the passing of John Warner, who was a courageous liberal Republican when the South was going very much conservative Republican. There's a whole path there of decisions that Senator Warner did. And now we have Senator Warren of Massachusetts with her sense of liberality as well. Tell me where the liberals stand right now. When Senator Warren gets up on her podium and lectures the banks, as we saw yesterday, how big is that liberal audience that she's speaking to?
Well, I think it's large and growing. I mean, this is the wing of the party that is pushing Biden to the left. He is, naturally a centrist. He is naturally a deal maker. And Elizabeth Warren's candidacy, Bernie Sanders' candidacy in 2020, and a whole new generation of voters who believe in big government and big government regulation are pushing the administration toward the left.
Do they have a critical mass? Or was it just what I'm going to call, with great respect for the process, the fluke of a Georgia 2 senatorial wins? Is there do you sense a critical mass of the progressives, liberals pulling in the center to make for a permanence?
It's a little hard to tell right now, Tom, because Donald Trump sort of skewed all the normal metrics that we use to gauge something like that. I mean, we don't really know if Warnock and John Ossoff were elected in Georgia in the runoff as a as a rebuke to the claims of election fraud from Donald Trump and his supporters, or was it really Georgia becoming a blue state? I think it's going to be 2022 or 2024 before we actually know that.
Wendy, is Donald Trump still the leader of the Republican Party?
Yes. Donald Trump is still the leader of the Republican Party. I mean, all of the Republican politicians, we can see with what happened with Liz Cheney and some of the others who are getting rebuked by state parties, by the National Party, by Kevin McCarthy, the House Minority Leader. They are all acting at Donald Trump's behest, or at least in what they believe is Donald Trump's behest, and he remains the leader of the party. What is the mystery to be solved is whether Republican voters are still as beholden to Donald Trump. And Donald Trump is restarting his rallies in June. The Republican Party is a little worried about that because they want the midterms to be about Biden's agenda, and the Democrats want the midterms to be about Donald Trump. They still want to use Donald Trump as a foil.
What does Donald Trump's leadership do when it comes to this counterproposal, this $1 trillion plan that we're expecting to see from the GOP regarding infrastructure? Because when President Trump was in office, he talked a lot about spending big. Is there a similar kind of push among the GOP, just with a different emphasis than the Democrats?
Yes, I think that's one area, Lisa, where Donald Trump is less in the picture. This is a really interesting phenomenon to watch, to see the Democrats and the Republicans going back and forth with one deal after another. A few weeks ago, Mitch McConnell said he'd be willing to spend up to $800 billion. Now, Senator Capito and some other Republicans are offering a plan that's closer to $1 trillion. Biden wants 1.7, but he's come down a little bit. So there's all this wheeling and dealing. Everyone wants some form of infrastructure deal as soon as they agree on what infrastructure is.
I look, Wendy, at where we are and the path forward, and what I see more than anything is great uncertainty. Greg Villiers writes this up this morning, massive uncertainty over infrastructure. Where are we in the summer quiet, the summer recess of your Washington? Is it just another year, or is there something unusual this time around?
Well, I think there will be something unusual. And of course, the summer quiet doesn't really start until August. So we have a couple of months for Washington to get something done. And they really believe that they can get an infrastructure deal in place by the end of the Memorial Day weekend, by the end of this coming weekend. So they want to come out of that with a deal, and then with hopes to vote on that and some other of Biden's economic priorities for the August recess. Because really after that, the midterms start and nothing's going to get done.
Some people might say they've already started. Wendy, thank you. As always, Wendy Benjaminson, Bloomberg Politics editor. Equities down about 0.1%. We're off by 0.16% on the S&P 500. The race to make a deal. Make a deal with who, Tom? Within themselves, within the party, or with the Republicans?
Well, we're going to make a deal, but I'm sorry, and Lisa and I were going back and forth on this. I just don't buy the bipartisan thing for a moment. The campaign of 2022 started that late Tuesday night, early Wednesday morning of November last year, and there's no indication I see, John, whatsoever of a bipartisan thrust. It's going to be war right up to it. Maybe it's a new kind of gridlock.
Do you buy it, Lisa?
Yeah, I do. I think that people say that both sides have an incentive to come to the table on some level. My question is, how much pushback will there be on both sides in the fringes of the parties, basically the ultra-progressive of the Democratic Party and some of the more conservative in the Republican Party? But yeah, I mean, from what we hear, they're actually negotiating somewhat in good faith.
Who needs to agree with the other more than the other, if that makes sense?
That makes sense. Yeah, everybody, this is a popular plan. So both parties want to seem like they are getting something done.
Is there more pressure on the Republicans to come to a deal with Democrats or Democrats to come to a deal with Republicans?
No idea. What do you think?
Well, I think for the president, he talked about unifying not just the country, he talked about unifying Congress, didn't he, Tom? On a campaign trail.
But it's too close. This is something that got lost in the review. The Republicans did really well in this election, in Congress. Did they take a majority? No.
Yeah.
Big speculation about the next time around. But I think the idea of Democrat Party dominance here is even now, John, still overplayed.
I hear you, Tom. The S&P 500, negative 0.16%. Coming up, Conrad de Quadros, Breen Capital Senior Economic Advisor.
Maybe he'll coach Real Madrid.
Equities down 7 on the S&P 500, negative 0.16%. You too, a little bit of tension today. Okay, 159.26 on 10s, yields up a basis point. On radio, on TV, this is Bloomberg Surveillance.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I don't know, stay in bed, enjoy the long weekend. Here's your market. The S&P 500 down about 0.2%.
What are you,
Negative 8 points on the S&P 500. I want to start it right now, to be honest with you, Tom.
He's selling it hard.
Nasdaq 100 down about 0.4%. Why sell something that doesn't need to be sold?
Here we go. What is this? Philosophical? Do
Switch
the
out the
data
board.
check.
Get to the bond market. Let's have a flavour of the 10-year.
The weekend start
in the US and Germany and the UK.
7:30.
The most interesting thing that happened in the last hour, a gentleman called Gertan Vliega of the Bank of England, talking with a lot of caveats about the post-furlough environment. What do I mean by that? There is a labour market support programme in the UK called the furlough programme, and as they start to unwind that, what does the labour market look like? That's the big unknown in the UK. There's a really smooth transition. You could talk about an early 22 hike. If you don't get a really smooth transition, you're talking about a late 22 hike. For whatever reason, the market's running away with a hawkish tilt, just a really subtle flavour of a hawkish tilt coming from that particular Bank of England member. Yields are higher in the UK by 4 basis points, approaching 80 basis points on a UK 10-year. Elsewhere, it's pretty subtle, unchanged by about a basis point or so. On a German 10-year, we come up just a little bit. Same story on a US 10-year too, 159.43. What's been remarkable about the Treasury market is just how stable we've been in the face of a conversation about tapering.
Yeah.
Finish on this. I want to finish on the gold price. Alan Ruskin of Deutsche Bank yesterday talking about, oh, ye of little faith is now, oh, ye of too much Fed faith. Just get your head around that. I thought it was nice. Do you like that, Tom?
It was like John Donne.
Wasn't it beautiful? Thank you.
It was
1892 on gold today, up by 10.72% over the last year. But it's this rally over the last few months that I think starts to get people's attention, because it really hadn't done a lot until very recently, and now it's starting to break out. And for the likes of Ruskin and others, Tom, this is where they're looking for maybe the inflation story to bubble away just a little bit more. Maybe we've got too much faith in that Federal Reserve view. Maybe too much faith, not enough anxiety elsewhere, and maybe this is where it's going to show up. The view, at least, from the likes of Alan.
I mean, John, you're poetic today. I mean, David Wilson.
Thank you.
Is
I'm really trying. I'm really trying. Just a little bit of flavour, some spice going into the weekend.
I got back to World War I there, a little bit of A.E. Houseman. I mean, you were nailing it.
I mean, I'm a poet, Tom.
It's just, it was like, Middle England. Or,
thank you. The Midlands.
Like that.
Just outside of Coventry.
David Wilson here to save us. He was talking with Dan Curtis, Bloomberg Television aviation correspondent, about Airbus and Boeing and some really interesting diamond. Am I right? Boeing with a pop this morning.
Yeah, absolutely. And it's all about what's going on at Airbus. That company telling suppliers. Yeah, at least a sign of it for sure. They're planning to increase production of their best-selling A320 series of jets. And they're looking 2 years out to have output levels that would exceed what they were before the coronavirus pandemic. We've seen the recovery in air travel. Now you're getting a sign of a recovery in airplanes.
Right after Siddarth's great story on this and Dan Curtis nailing the research on it, Boeing to pay $17 million for production lapses relating to 737. They got some problems that won't go away.
Well, and they're still dealing with the recovery of the 737 MAX jet, no question. But, here at least you have a positive sign for the industry. And I should point out, Boeing supplier Spirit AeroSystems also higher in early trading. Then we turn to Snowflake. This is a data warehousing software company. Warren Buffett's Berkshire Hathaway is among its investors. Now, their latest quarterly numbers didn't go over so well. Fiscal fourth quarter loss wider than analysts expected in a Bloomberg survey, and they're looking at slower growth in product sales. That's basically the bulk of their business this quarter. Now, I say slower, they're talking as much as 92% as opposed to 110% in the previous quarter.
And the symbol snow.
Yes, it is.
How cute.
All right, Berkshire actually invested in this company before it went public, which is telling you something.
The great bio name escapes me right now. I did the interview on it. I mean, that Snowflake is like
Snowball.
Snowball.
That's what you're thinking of. Alice Schroeder's book.
Al Schroeder's book,
yes.
Her work at DLJ years ago. The Snowball, Snowflake, that's it, right?
I suppose.
We're killing it this morning. Give me a couple more.
All right. I do have a couple more.
Please.
The meme stocks, if you will, the ones that are favored by those amateur traders on Reddit. They had a bit of a run-up this week, and they're pulling back today, though. We're seeing some volatility. They've actually come off their overnight lows. GameStop, of course, the video game retailer, and AMC Entertainment. We should point out GameStop's been up 37% in the past 3 days. AMC up 62%.
You having fun in there, Tom?
I don't know. I'm just waiting for Wilson to break into poetry like you. You're doing Pharaoh's doing A.E. Houseman. What do you want to do here? You want to do,
E.B. White.
I mean, E.B. White. Thank you, E.B. White.
I don't know. I'd probably go for Bob Dylan. He did have his 80th birthday this week.
80th birthday. Was this cool?
Yeah.
Let's stop it here. Wilson is really, Conrad DeQuados is going, what are they talking about? Lay Lady Lay and Nashville skyline has just simply endured.
I mean, a lot of his songs, even some of the more recent ones, you know, think about a song like Beyond Here Lies Nothing.
Yeah. See that, Farrell? It's just like this show, we go off the rails.
You're crushing it this morning, Taz. You're crushing it.
David Wilson
Dave,
back.
you.
He'll be on tomorrow talking Brooks and Dunn.
Look forward to that.
Yeah, thank you. Conrad DeQuadros with us now to save the show with Breen Capital and their senior economic advisor. Conrad, what is the tendency of a GDP guess right now? Are you guys guessing a more buoyant America, or are we really going to see a surprise here into the lethargy or the post-boom economy lethargy that some are worried about?
Well, over the next couple of days, we're going to get a lot of important information on that. Today's durable goods orders report gives us the first look at capital spending at the start of the second quarter, and then tomorrow we're going to get the consumer spending numbers. And you know, it's looking like the second quarter could be a double-digit gain in GDP, particularly because of the strength of the consumer. The consumer spending has been extremely strong, and so. Now that brings us to, you know, where do we stand in the economy relative to where we were pre-COVID? And it looks like the GDP gap may have completely closed by the second quarter. If not, it looks like definitely by the third quarter. So the GDP, the production side of the economy has been extremely strong.
Conrad, given where the year has gone so far, how we started the year, what was your view on 22 compared to where it is now?
Well, now it's stronger. You know, we're looking for you know, strength in 2021 as we're rebounding as the economy reopened. But you know, it's looking like this probably has some legs, and a lot of that has to do with the consumer and the fact that we have this large accumulated savings. You know, much of that's going to be used up over the summer as services spending comes back. But just the amount of savings on the consumer side and the amount of money that's there to be spent, 2.3 trillion is our estimate of the amount of savings above what would be a normal level if we hadn't had COVID and all of the federal programs that followed. So that's going to probably give the consumer some legs. And the fact that the business side of it, the investment spending, is also looking like it's bouncing back, at least on the survey data. If we look at the manufacturing surveys that we've had, even through May, capital spending expenditures have rebounded quite sharply. So that's very encouraging. And so, you know, we're looking for obviously reopening related very strong growth in 2021, but it's looking like this has some legs into some continued above trend growth in 2022.
Conrad, you've touched on the key variable of the moment, and Lisa, Tom and I were talking about this earlier this morning. It's somewhat easier, relatively speaking, to come up with that $2.3 trillion number you came up with for the additional savings, given where we are if we didn't have this pandemic. Getting to a point where you understand how those savings get spent and whether they will be spent, I would suggest is harder. Conrad, how do you go about drawing conclusions around that?
You know, I think that's a very good question. I think one of the things we need to do is look at which cohorts of the household sector where those savings have built up. The more recent federal programs, the ones that kicked in this year, both the January payments that were made, the March payments, those were directed more towards lower income households that have a higher propensity to spend. So I think a lot of that money is going to get spent, and the coming months are going to show. But what we know is, for example, look back at March and the retail sales report. As soon as things started to look like they were getting better, the labor market was starting to recover. We were starting to make some progress on vaccines. We had this surge in spending. So you know, I don't think that this is by any means savings that's precautionary and that we're likely to see higher savings rates than what we'd seen pre-COVID. I think those savings rates are going to come back down. You know, we were looking at a pre-COVID savings rate at about 7%, and I think that's the direction that we're going to be headed to over the coming months.
So, John, Tom, you guys were laughing at me earlier when I said that possibly Snoozeville was stemming from the fact that everybody was going on vacation. But Conrad, seriously, when I talk to people, everyone is going on vacation. They are booking flights. They are looking to get out of the small sphere that they've been living in for the past 14 months. The question is, will some of those service providers, the airlines, the hotels, be able to hire enough people? How important is it for these frictions to be evened out in the near term for spending to continue at the pace that you expect?
Well, Lisa, I think that's a critically important question. You know, tomorrow we've seen the retail sales report for April. Tomorrow we're going to get some information on the services side of consumer spending. And I think that's really what's going to drive the economy over the summer period. But you bring up the important point. What are the impediments to getting people back into jobs in the services sector, the restaurant industry, hotels, airlines? That's very important. And we're still trying to figure out, and I think that next week when we get the jobs report, we'll have some more information. In our view, there clearly is an issue with the lack of labor supply. We can see that from very high levels of job openings. We can see that from the small business survey, for example, which is showing record levels of percentage of companies that can't fill jobs. There are questions about what is driving that. Is it the fact that we have enhanced unemployment benefits? Is it just continued concern about getting sick? Transportation issues, childcare issues? I think it's going to take some time to resolve that. And it might take much of the summer. For example, on the childcare issue, it might require the reopening of schools after the summer and people returning to more normal family environments that will allow some people to get back to work.
Conrad, got to leave it there. Thank you, sir. Conrad de Quadros there, Breen Capital Senior Economic Advisor. It might be late August, September, Lisa, until we figure some of this stuff out. The kids go back to school in September, and then the additional UI expires then too.
I'm not counting down the days till the kids go back to school full-time.
Sounds like you are.
Maybe, just maybe.
Like
well, I mean, look, that is a huge issue. If your kids are at home and they're looking for something to do, how do you go back to a job that keeps you away from the house all day?
TK loves getting away from the house.
No, this is serious stuff. I mean, I think
I know it's serious.
Getting away from the house or childcare.
The path to the third week of August is a huge social statement for this nation. I don't know if we're ready for that challenge, if you will.
Coming up in the next hour, Congressman French Hill, the Republican from Arkansas. Looking forward to that. Equities down 9. We're negative 0.2%. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. British Prime Minister Boris Johnson is hitting back after his former strategist Dominic Cummings said he was unfit to lead the country. Whilst visiting a hospital today, Johnson said some of his comments, quote, bore no relation to reality. Johnson refused to comment when asked about Cummings' assertion that he said he'd rather, quote, let the bodies pile high than order a third national lockdown. Australia's second largest city entered its fourth lockdown today as concern grows over the rapid spread of infections from a coronavirus variant. For the next week, people in Melbourne will only be able to leave home to shop for food and essential items, get medical care, work or study, or to get vaccinated. The country's health minister said the move is, quote, highly regrettable but necessary. And a panel waiting an impeachment inquiry against New York Governor Andrew Cuomo is being accused of dragging its feet. The panel met Wednesday for just 5 minutes before heading into a private session. State lawmakers and government watchdogs say the process is moving too slowly, giving Cuomo time to redirect the political narrative. He's facing allegations of sexual harassment and accusations of covering up COVID nursing home deaths. And Airbus plans to ramp up production of its best-selling A320 series beyond pre-pandemic levels within 2 years. The world's biggest producer of commercial jetliners is telling suppliers to be ready to raise output of its top-selling narrow-body to a rate of 64 per month by the second quarter of 2023. And Airbus says that could climb to 75 per month by 2025. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
The bigger gap is around what's called exchanges, crypto exchanges. And I would think if we could work with Congress to try to bring investor protection to the platforms where these sometimes commodities, sometimes securities are trading on the platform.
That was Gary Gensler there, the U.S. Securities and Exchange Commission chairman. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's your price action. Equities down 8 on the S&P. We declined 0.2%. Yields are higher on a 10-year to 159.77. Yields are up by a couple of basis points. Euro dollar 121.95. Totally unchanged. Here's a story that has really changed in the last 12 months. The high of last year on dollar China was exactly 1 year ago. We had a 7 handle. Right now, we're at 637. It has been a severe move into the yuan's favor. That is a stronger Chinese currency. And we've been waiting for some commentary from the PBOC, the People's Bank of China. Yeah. And they go on to say the following. The current Forex market is balanced. The rate is impacted by many market and policy factors. Now, here's the important 2 points. Yep. It cannot be used to offset commodity price increases, i.e., we can't let it strengthen to offset the impact from the commodity market. They go on to say, can't also be used to spur exports either, i.e., we can't allow it to weaken to spur exports. Now, Tom, what's interesting about this is the S word is missing, stability. This is a Chinese central bank that's looking for the S word, stability. I don't see it in this particular release, though.
I think Bloomberg's really been leading on this. Richard Frost and Tian Shen out of our Hong Kong News Bureau have really written this up smart. And the idea that they would step away from managing the currency, as John Farrell mentions. We get lucky. Previously scheduled on other themes. Enda Curran joins us, our Bloomberg Chief Asia Economic Correspondent. And the key headline, as John underscores there, is a discussion of a stronger currency offsetting the reality of copper being very, very expensive. That's FX 101, but this is not a floating currency, is it?
No, it's not. These are very direct comments from the central bank in Beijing, Tom, and it does look like they are trying to manage expectations. I can tell you that manufacturers here are screaming out in terms of the input prices they are facing, especially in terms of the imported commodities. We've spoken to a lot of factories in recent weeks, and all of them make this point that they're struggling now given the cost base that they're facing. But clearly, the PBOC has felt the need to come out and offset any expectations out there that the exchange rate can necessarily be levered at pull in the middle of all of this. And I should say, John pointed out, they're also making clear it's also not about pulling it to the downside to help exports either.
I mean, and what's so important here, I was going back and forth by chance this morning with our Tanya Chen in Hong Kong, and 20 years ago, Ken Rogoff at the IMF was talking about this and the underlying theories of the late Rudiger Dornbusch. And the answer is you're floating or you're fixed. And then there's a PBOC with their own rule book. Do they actually control foreign exchange dynamics in China, or is a market intruded in to change that formula?
It's clearly a managed currency, Tom. It is a manipulated currency, but nonetheless, they have been allowing the market to have a greater say in recent years. This year, the yuan has been on a tear. In fact, it's at its strongest level now since 2016 when you look at it against a basket of trading partners. And that is certainly an obstacle for China's export story. And we know that exports have been a big part of the recovery story there, given the lagging consumption story. But China does control the currency, it controls it very tightly, but I think what they're doing tonight is trying to send this message that they are responsible global players, that they are not going to step into this commodity rally by using the exchange rate as a weapon or a tool in the middle of all of this.
And there is a question here, as the UN does strengthen, it invites more foreign flows into the country. Does the PBOC want to see that or not so much?
We had record flows going through Hong Kong this week into China to buy Chinese securities. On the one hand, China is actively seeking foreign capital, Lisa. They are opening up their financial markets. That's been a big part of their policy push in recent years. There does come a point, though, where they are worried it might be financially, or it might trigger financial instability. They have warned about bubbles in recent months. They have said there could be a point whereby there is too much capital flowing in. But I don't think we're there yet. We haven't heard the PBOC pull any levers to slow the flow of capital going into China. They've done some fairly modest jawboning. Right here, right now, they are welcoming of the money that's going in. But you're right, in the bigger picture, too much money flowing in means stronger yuan and may trigger bubbles in China's domestic markets.
I mean, John, it's an acclaimed chart. For those on radio, it's real simple. The history of 2005, where China gives in, and it's an ever stronger yuan for years. And John, we really need to understand, we revisit that 2014 strength with somewhat of a move down to the 6th level.
Yeah, and Tom, in addition to that, what's key here is that the Chinese authorities have been tolerating it. And they've been tolerating the additional strength. Do you expect that to continue? Are we going to be laser focused on the fix all week, all month for the rest of this year?
I think it will remain a focus, John, but I think the real turning point for that will come when the export story starts to lose steam. China's exports have been going gangbusters, therefore they've been able to tolerate this strong exchange rate. When we reach a point where that manufacturing story starts to ease off, maybe it's global demand cools or the rest of the world catches up, that's when you'll see these exporters start to say, wait a minute, we're suffering here from higher input prices and we're suffering from a strong exchange rate that will put pressure on the people's central bank, and then they may start to allow some steam come out of the yuan. But as I say, we're not there yet. They do seem to be sending this message that they're broadly comfortable where it is, and that seems to be another message tonight about managing expectations.
And what a timely conversation. Thank you, sir. Enda Curran, Bloomberg Chief Asia Economics Correspondent. If you're just tuning in on TV and radio, exactly 1 year ago today is where dollar-China, that currency pair, actually topped out last year when we had 7.1671. Right now, 6.37 on dollar-yuan. And a bit of commentary from the People's Bank of China as some people started to raise the question that maybe they'd push back against some of the commodity strength by introducing maybe a little bit more Chinese currency strength, Lisa. They go on to say that it can't be used to offset the commodity price rise. additional strength. They also go on to say the exchange rate can't be used to spur exports either. Maybe some weakness.
Well,
the idea being here, Lisa, maybe stability is the way forward.
Well, and the idea here also, it can't be used to spur exports either, speaks to some of the rising tensions between the U.S. and China. And we are seeing that Joe Biden has sort of reiterated some of the rhetoric from President Trump. Recently, his Asian czar says the era of engagement with China is over. It is now going to be an era of competition. You wonder how much that's feeding into the PBOC's stability call.
Yeah, and this commentary, Tom, as Lisa alludes to the fact that this was the first talks between the two trade leaders in the last 24 hours.
Well, yeah, maybe a talk in the last 24 hours. I should point out here, John, very importantly, this is what President Trump wanted. I mean, let's be honest about it. He wanted weak dollar to spur U.S. exports. And, you know, you never know how you get what you want. But President Trump certainly has a yuan delivering at 6.377 on its way to 6.
From New York City this morning. Good morning. Things getting a little bit more interesting.
Yeah.
As the day grows a little bit older. Peter Chair joining us next, Academy Securities Head of Macro Strategy with Tom Keene, Lisa Abramovitz. I'm Jonathan Ferro. Your S&P 500, 4186, down 0.14%. Yields are higher by a couple of basis points on a 10-year at 159.43. Euro dollar 121.98. We are basically unchanged. And crude heading south, down about 1% on WTI. From New York, on radio, on TV, this is Bloomberg Surveillance.
Traffic. Okay. During the pandemic, no traffic. Okay. Where do you see the oil market in about 20 years or so? Non-existent.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What investors need to differentiate between is, first, where are we in the cycle? Second, what's the direction of the economy?
People are vaccinated and they're still not ready to get up and go and do things the way they did them before.
What we've seen for most of the year is quite a bit of anxiety about potential inflation.
We're looking for a slowing rate of equity gains. There's definitely some storm clouds that we're concerned about.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Really boring Monday, less boring Tuesday, Wednesday, and all of a sudden, Thursday is interesting for $6 trillion reasons. The New York Times, John, moments ago, coming out with a line item on the Biden view of a $6 trillion statement for fiscal year 22, and the dreaded I words there, infrastructure.
Here's the lead paragraph. President Biden will propose a $6 trillion budget on Friday that would take the U.S. to its highest sustained levels of federal spending since World War II, while running deficits, Tom, above $1.3 trillion throughout the next decade.
It is our modern monetary theory. We're going to be diving into this through all the morning. It's huge news here as we reframe the fiscal solutions of the United States. The Bank of England, John, you're more up to speed than I am, talking about this moments ago, and sandwiched between them, the Central Bank of China adjusting the tone on a stronger yuan. Things are, the plumbing of the global system, John, seems to be working this morning.
Well, let's start with China. China coming out, the PBOC, the People's Bank of China, addressing things pretty quickly with the exchange rate that topped out a year ago today. We will not use the exchange rate to offset the commodity price rise. We will not use the exchange rate to boost exports either. That's the China side of the story. I just want to go to the bond market here in America. Here we are talking about $1 trillion plus deficits throughout the whole of the next decade. Here we are talking about the Federal Reserve having a conversation about pulling back on its asset purchase program. And here we are looking at a 10-year at 160.45. Which I understand over the last 12 months is a change from where we were because we were aggressively lower from here. But over the last decade, 160.45 by any measure is exceptionally low on a 10-year yield. And we're having this conversation about stimulus, this conversation about paring back things at the Fed, and we're still down here.
And what's so important about this, folks, as we dive into this within our economics, our finance investment, we get Lucky French Hill from Arkansas with us in this hour. I wonder what he'll think about $6 trillion. Lisa Abramowitz, the sum solution of John's observation on interest rates and the sum solution of Elizabeth Warren's statements yesterday to fancy bankers is the inequalities of this nation are exceptional.
Well, that's why there is this increased spending that President Biden is proposing. That is one of the reasons behind it. I do want to just say that building on the point that you guys were just talking about, Jim Reed of Deutsche Bank came out and asked the question this week, when does debt matter, when debt doesn't matter anymore? And what you've seen is an increasing debt to GDP ratio around the world and yields coming down. Greek yields now the lowest relative to German yields going back to 2008, despite the increase there. I mean, everywhere you look, you see this phenomenon, which raises a question of whether this can persist or whether this is just a blip before we start to go to a new regime. Tom.
I mean, John, we're not doing macroeconomics here at 8 a.m., but there's got to be an end result in leakages, and it's usually personified, John, I would suggest, to the foreign exchange market.
Look, pretty much every cycle over the last several decades has been the same. Every single recovery, we add more debt. Debt to GDP continues to rise. Every single recovery, the peak in, say, the Fed funds rate is that little bit lower. Every single recovery, our tolerance for higher interest rates is diminished. And for a developed market like the United States, that is still true. Lisa, what's got to change is this belief that somehow treasuries are treated differently, not like a developed market sovereign, that we start to get worried about repayment. risk, credit risk, and clearly at 160.45, that's not it.
Well, the Fed's reaction function matters here because they have been accounting for and buying up a lot of the new issuance. If they step away, will there be the buyers to pick it up? In other words, you know, to your point, does that change the scenario because it is the biggest, deepest market, or do we see the same trend that we saw in the Japanese bond market?
John, let's look at the markets, and they actually move here. We've been making jokes about it all morning, but Mr. Biden and certainly the report in the New York Times, John, you do get a spike in futures. We were red before, and now we've got some legitimate Dow Jones industrial average. John, the 126th year of the Dow Jones industrial average, green on the screen.
We'll celebrate that next year. 160.62 on 10s, climbing higher by 3 basis points, Tom, on a 10-year. We do creep a little bit higher, back through 160, Tom, at 160.45.
You know, I just say, folks, our booking team, they've all got crystal balls and they've got sage going, you know, in the aisles here. They just are magical about getting us to the right guest at the right time and to Kerr in there on the PBOC by chance. And right, you know, Maria today on Real Madrid, I had tears in my eyes. She was so good. Right now, Peter Cheer joins us from Academy Securities on what we see in the markets. Peter, it's the question we've all been yammering about, but you're the pro. Why aren't yields moving given our fiscal stance, our fiscal numbers?
I think there's three things. One is the Fed continues to buy a lot of debt, so that's offsetting it. We're seeing corporations able to defease their pension plans, so they are net sellers of equities to buy debt. And then I think just no one really believes that either we're going to get the fiscal stimulus at its full extent because that bipartisan feeling is gone. And also, quite frankly, no one really seems to believe that inflation is going to be anything but transitory. I do think it's going to be persistent, but right now the market hasn't seen inflation for so long that they're downplaying that potential.
I don't think the number one question has changed that much, Pete, when it comes to a Treasury sell-off. How self-limiting would a Treasury market sell-off be? How self-limiting would it be?
I think it would be very limiting. You know, when we go back and people want to talk about taper tantrum, you see much, much different positioning. All you even have to do is look at some of the ETFs, like an LQD, which is a long-dated investment-grade bond, TLT, long-dated treasuries. They've all had significant outflows. So the market is much more prepared for a tapering type event. And if the Fed needed to, they had things like Operation Twist that they could pull out. So I think we could get to 2% on the 10-year this quarter, but it's going to be a struggle and nothing's going to gap a lot higher. It's very much under control at the moment.
You think we could see a cycle high? And I know it's early days and it's hard to make this call, Pete, but you can envision a cycle high of 2% on a 10-year.
I think we're ultimately going to push up towards 2.25%, 2.5%, but that may be later this year or next year. And that's only once I think this inflation story becomes embedded. And I'm a little bit suspicious about what China was saying today, for example. I do believe China is working towards that shift to a domestic economy. So they care less about providing us with cheap exports. So I think there's all sorts of inflation stories out there away from this commodity rise that people aren't talking enough about, and we'll start focusing on this summer.
So what does that mean in terms of investing? This idea that there is a sort of self-limiting factor to the Treasury sell-off that could potentially happen, and yet we do have price to perfection when you look at certain aspects of credit markets and when you look at certain slices of equity markets. Where are you seeing value?
You know, I think it's going to be about a domestic growth story, right? We are going to see supply chains shift. I think there's going to be a real push to help build up our 5G, and anything that we're kind of on that tech side competing with China, look for infrastructure spending and a real domestic focus. So I think that industry is really exciting. I think you're going to see a push to bring back a lot more healthcare, you know, medicines, pharmaceuticals. That can't be all sourced from China, given this kind of level of friction and competition. So we're going to see that brought around. That's going to change supply chains, change where things are, you know, made. I think that's the real opportunity, figuring out what this economy is going to look like in 2 years with this push towards sustainability, with bringing back some of these industries, and that's where the real opportunity is going to be.
Peter, the full faith in credit space is not so much yield, but the price. There's somebody bidding on this paper. Now, you mentioned the government and the U.S. government in as well. Do you see within your macroeconomics that the foreigners will walk away and all of a sudden the price will drift down and yield will drift up?
I think we're actually okay on that, even when foreigners are stepping away, which is becoming a little bit more likely given that we have the worst negative real yields. I always get confused talking about negative real yields, but you can actually earn more on an after inflation basis in Japan right now, probably even in Germany, which seems bizarre given that they have lower negative yields than us. But it's that real yields. I think it goes away, but there's just so much support from corporate pension plans, from pension plans in general, from retirees. I don't see it getting out of control. People are too positioned for it to get out of control. And finally, the Fed has a lot of tools that it can bring out if it starts seeing that risk. So I think that we see yields go higher, but it's more of a steepening, and it's relatively gradual, and it's not going to be an impediment for stock market either.
Pete, get back to New York soon. We need to catch up. It's good to hear from you, sir. Peter Schier, Academy Securities Head of Macro Strategy. Gerdon Vlieger of the Bank of England was talking a little bit earlier, and the market ran away with a hawkish interpretation of it. Not for me to say whether that's right or wrong. He also went on to say, negative rates are a relevant tool if the recovery is delayed. Can you believe, TK, that there are still central banks talking up the usefulness, the efficacy of negative interest rates?
Well, we're still talking about it, and it's there. But, you know, we've had a little bit of a pullback on a German 10-year yield, John. But I think the jury's still out on negative interest rates. We got more to see there. And again, when's the ECB meeting? I'm sorry, I lost track of it.
June 10th.
June 10th. That's a huge deal. I'm sorry. They've got to recalibrate for a lesser negative interest rate right now.
Lisa, the ECB?
Well, this raised a question earlier when you said that each cycle we go lower with the yield, we take on more debt. So if you're at zero, where do you go? And this is actually a serious problem in terms of what kind of ammunition does the Federal Reserve, does the Bank of England have in the next crisis?
Yields did rise in the last 10 minutes or so as that New York Times story dropped by about 3 basis points on a 10-year now, back through 160. The lead paragraph, and I'll repeat it if you're just tuning in on radio and TV, President Biden will propose a $6 trillion budget on Friday that would take the U.S. to its highest sustained levels of federal spending since World War II, while running deficits above $1.3 trillion throughout the next decade. And Tom, you remember the people that were going on and on about the budget deficit through $1 trillion and what it would mean for this bond market, that things would start to crack. Is this it?
Well, John, it's important. Jim Tankersley's done a huge job in this. I don't know what draft he has of the budget over at the New York Times, but it's a detailed story. 117% total debt 10 years out. That number is on the edge of Japan, John.
Coming up next, Ken Leon, CFRA Director of Equity Research from New York. Equities down around about 0.1%, new in negative 0.08%. Yields are up 3 basis points to 160.45 on 10s. On radio, on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. President Biden will reportedly propose a $6 trillion budget on Friday that would take the United States to its highest sustained levels of federal spending since World War II, whilst running deficits above $1.3 trillion throughout the next decade. The New York Times is reporting that Biden's plan calls for the federal government to spend $6 trillion in the 2022 fiscal year and for total spending to rise to $8.2 trillion by 2031. British health officials say it's too soon to say whether the country can go ahead with stage 4 of its reopening the economy on June 21st. UK Health Secretary Matt Hancock told Parliament today the spread of the variant first identified in India has the potential to throw a wrench into plans. Hancock says he, quote, desperately wants to reopen the country but can only do it if it's safe. Bayer is considering removing a controversial ingredient from its Roundup weed killer in the U.S. after a judge rejected a proposal to resolve future claims that the weed killer causes cancer. Bayer says it will review its U.S. residential lawn and garden business. The rejected settlement is part of a broader $11.6 billion agreement to resolve Roundup lawsuits in the U.S. following its acquisition of Monsanto. And ExxonMobil CEO Darren Woods has been dealt a stunning defeat by shareholders. A tiny activist investment firm snagged at least 2 board seats and promised to push the crude driller to diversify beyond oil and fight climate change. It was the latest setback for Woods. The oil giant, once the world's most valuable company, has shed more than $125 billion in market value during his tenure. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
How much did J.P. Morgan collect in overdraft fees from their consumers in 2020?
Well, I think your numbers are totally inaccurate, but we'll have to sit down privately and go through that.
These are public numbers.
And I also want to point out we did not overdraft.
Can you just answer my question? How much did J.P. Morgan collect?
We did not overdraft at the Fed account. And at any request,
so you never. I'm sorry, Mr. Diamond. Mr. Diamond, will you commit right now to refund the $1.5 billion you took from consumers during the pandemic?
No.
It's enough to give you a headache, isn't it? Goes on for hours too. It's Ken Leon, CFRA. Is going to be joining us in a little bit on this, Tom. What's your take on it?
My take on it is Afterthought nailed me at Glossier, and I got an overdraft thing from Diamond here. I think I gave $34.95 to Jamie Dimon at some point
over the last year during the pandemic. If you gave JP Morgan a call and said, you know what, can I have that money back? You get it back.
Really?
Just how it works.
Don't let Afterthought know that.
Let's get to the market.
There
Equity futures down 4 on the S&P 500,
it's an interesting
41.89. It always frustrates me that there are politicians in Washington who just believe the electorate are a little bit stupid. It just drives me insane that we need to hold everyone's hands. You can get on the phone. I used to do this when I was a kid, when I went overdrawn as a student. I used to go into the bank and ask for the overdraft fee.
How often did that happen?
A lot.
Right, let's get to those markets.
Used to have a lot. Anyway, yields up 3 basis points, 160.96. FX, euro dollar, 121.95. It's cathartic for me, Tom.
Yeah, we got a yield move, John. We got to explain the 10-year yield move here. Ken Leon's taking notes.
Look, we've had a piece from the New York Times about the size of the budget down in Washington. A budget, as you know, Tom, that often does not get passed. But ultimately, the prospect of having deficits north of $1 trillion for the foreseeable future through the rest of this decade is part of the story, part of the dynamic for bond yields and the bear case for treasuries, at least.
Ken Leon provides massive wisdom to us when we have earnings. He is with CFRA, the Director of Equity Research, but he has an historical reach on our financial system that is just wonderful. We're thrilled he would join us this morning. Ken Leon, this is about culture and failure. HSBC came in 40 years ago. They were going to do retail banking in America. And what is so interesting to me me is the 10 branches they're selling to Cathay Bank of Los Angeles. Ken Leon, this is a bank that was built from nothing in Chinatown in LA. You go down Broadway in LA, past the HSBC branch, you turn onto Alpine, boom, there's Cathay Bank growing every day. And it's because Chang Lewin, the president of Cathay General, they deal every day with the people. What did HSBC get wrong on the culture of banking in America?
Oh, great. Thanks for having me. And Tom, this train left a long time ago, years ago. HSBC, first of all, this is a global bank. They got $1.4 trillion in wealth management assets. They are strong in Asia, a position strong in UK. And North America just doesn't matter. And, you know, with the news today, even if you took out HSBC, could it have been Citigroup? Well, the difference is HSBC sold in the consumer bank their credit card business years ago. Citi did not. Citi's only in like 3 or 4 states in the U.S., but it's formidable. It's one of the top 5 banks. HSBC, I think this is a move just to go to where their strengths are, and it's not in the U.S. market.
You know, Ken Leon, I look at AT&T jettisoning Warner Brothers and what Plepler, who built HBO and Game of Thrones and all that, said. It is about culture versus strategy. Okay, Cathay Bank and Shanghai out in Chinatown in L.A., they're building a smaller bank, very centric China-Asian model in L.A. What's the culture model for James Dimon, who says he needs hard work to make this go? What's the culture model for big banking 5 years out in America?
Well, particularly for J.P. Morgan, you know, versus other U.S. banks, it has sizable presence in the capital market. So it's a quasi-investment bank. That culture permeates the bank, but they're also a world leader in terms of consumer. It's the ability to get a hold of technology, fintech, and harmonize with your brick and mortar of bank branches and financial centers to delight the customer. And there's new fintech and disruptors coming into the market, including Goldman Sachs. So you got to be on your best game. And, you know, I think for J.P. Morgan or Bank of America, they really execute well in the consumer area.
Ken, what did you make of the story that we put out this week on Square maybe getting into business banking?
Square really has 2 principal businesses, and it's a super high growth tech company, if you will. One is payment processing, the other is cash. And it's just leveraging their platform to gain share, whether it's from the banks or other established players like Visa or MasterCard. It's, you know, there are savvy players here. It's not like J.P. Morgan or Visa is not investing. They're investing billions in technology. So I would say it's just a sign of where we're going. And for those banks that are not investing or don't have the capital size, it's going to be tough to compete. And that's probably where Square is going to gain share, in the middle-sized banks.
Ken, when are we going to start to see the big U.S. banks acquire some of these fintech names?
So they've already made seed investments in venture capital. We haven't seen anything, to your question, related to sizable multi-billion-dollar acquisitions. But, you know, all these banks, you know, it's like Jane Fraser, CEO of Citigroup, you know, former McKinsey, James Gorman, former McKinsey. Like a consultant, they got to say, what do we need in our bag to really compete? And if it's technology, we're going to go out and acquire it. So it's going to happen, especially if they don't have hundreds or thousands of software developers to make this work.
Ken Leon, thank you, sir. CFRA Director of Equity Research. HSBC could not get the scale, and they just couldn't invest in the product here either, Tom. You know, as someone that grew up in the UK, obviously coming over here and going to HSBC, not good.
Yeah, what do you think about it, John? I mean, I think you've got a really unique perspective on this versus, you know, to me, it's across the causeway from our offices in Hong Kong. How's the HSBC perception in the United Kingdom?
The product in the US just is not good enough. In the UK, it's pretty decent. I know a lot of people that have HSBC bank accounts, but here, Tom, just not good enough. Not enough money invested in it. If you went in with a check, still had to fill out the form, just very cumbersome, a lot of paperwork, just not good.
I can't say enough, John, about what we're learning Warner Brothers, and whether that goes to Discovery and all of that coming out, Amazon buying MGM and such. This cultural overlay among all the finance, the investment, all the McKinsey talk, as you call it. I just think the culture overlay, like Cathay Bank out in LA, is a huge, huge deal. And I should point out Citizen Bank of Providence buying the East Coast branches.
Yep. Enjoy the McKinsey talk, don't we, Lisa? Quite often.
Really?
Synergies.
Yeah, Tom loves that.
What's the other word we like? Synergies.
Oh, I can't. There are too many.
Efficiencies.
We're innovating
that's good.
ourselves towards execution.
Innovation towards execution.
Yes.
What does that mean?
It sounds good.
It's a paradigmatic shift.
Are we innovating ourselves to executing the show?
That is a world-class MBA. That will cost you $200K, Tom.
Yeah.
Right?
We have synergy towards our new paradigm.
Coming up.
Speaking of paradigm,
David
can we
Kelly at
spend
JP
more than a
Morgan up
dime on
next.
the tang that I'm having this morning?
This is
It's just,
Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
Certainly feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
from New York for our audience worldwide. This is Bloomberg Surveillance live on TV and radio. Seconds away from economic data in America. Going into those numbers, 41.89 on the S&P 500. Equities down 4. We're negative 0.1%. There's your data on time this week, Mike McKee. Good morning.
Yeah, well, we're hoping that we continue to get that kind of speed out of the government. Durable goods orders coming in down 1.3%, which is a big disappointment because they were expected to be up by 0.8. The prior month revised, can I say the word, to 1%, so you pick up a 0.2 back there, but it's still a decline in durable goods orders. Ex-transport, though, up better than expected, 1.0, so I haven't gone into the details yet, but it looks like this is cars, probably, because car production shut down with the chip order problems. Capital goods orders, non-defense, ex-aircraft, this is the one that we watch because it suggests where business spending is going, and this is good news. 2.3% gain for the month of April, better than the 1% expected and better than the 1% we got in the month of March. So there's some good news there on business spending as companies start to come back from the pandemic. Jobless claims, this is kind of fun. We almost made it below 400,000. 406,000, that's a drop from 444,000 the prior week. And so we are at our post-pandemic low by a lot. Remember when we were around 1 million? We're getting back down into the area where we used to be before we got into the 200,000s. This is a much more normal look. GDP comes in at 6.4%. That's a tenth less than it came in the initial print. But the initial print, 6.4%, I'm looking to see where the change is. It looks like personal consumption went up by 11.3%. So the former was 10.7. So it looks like it was probably in another area of that. And then just looking quickly here, I don't have the profits numbers yet.
Well, Mike, you go through the details.
Numbers we want.
I'll run through the price action just quickly. Yields elevated, up almost 4 basis points on a session now to 161.31 on a 10-year maturity. In the equity market, we stay negative at 41.89 on the S&P 500, down about 0.1%. But TK, that is the right kind of downside surprise on jobless claims. We want to see more of that.
And it's going to go into what we see, you know, the GDP when Michael McKee breaks it out. And again, personal consumption there booming. Mike McKee, can you correlate a really elegant claims chart in the path of claims to a better place, to the unemployment rate or to GDP? Do they link together?
They link together in the broadest sense, but remember the GDP is first quarter, so that was January, February, and March, whereas we're looking now at what's going on going forward, and I think that's what people are really going to be concerned about with the fact that we're seeing the jobless numbers drop as much as they are will feed into what the Fed is thinking about the labor market, which therefore feeds into what the markets are thinking about the Fed. Durable goods orders suggest some strength, and if you've got a lot more orders coming in, you may need more people, so it all may link together.
Meanwhile, tomorrow we're going to be getting personal income and personal spending data, as well as the key PCE figures. Are these really much more important at this point, given where the Fed is at, than even the unemployment figures, the filings that have been really noisy?
Yeah, we're going to watch those numbers, importantly to see in terms of personal spending, especially because we want to know what the services component of spending was. We know that people spend a lot more on goods. Are they starting to spend more on services? You can back some of that out of the GDP numbers, but this is going to be the first month of GDP for the second quarter reported, so we don't have that information yet. And of course, we get the PCE price index, and that's the one the Fed follows. We'll see what kind of inflation we're getting there, whether it matches the kind that we saw with the CPI last week.
Mike McKee, thanks so much. The 10-year yield, again, as John Farrow mentions, 1.61%, very different from the 157 that we saw, 2 hours ago, let's say, with the news flow that we have. David Kelly joins us now, JP Morgan Asset Management, and he knows his beloved Liverpool finishing strong, I believe third in the Premier League, certainly doing better than the Tots. And David Kelly, you know, well, there's the yellow card and the red card, and what you look back as to your Catholic upbringing, all those B's and C's you earned in attempt to a pink card. You do a mid-year review, and you got a pinkish A-plus tone to the American economy.
Well, yes, and this latest set of exam results, I think, will, if anything, improve that. You know, we didn't see GDP move up, but what we did see is inventories actually fell even more in the first quarter than initially reported. And what that means is you get a big inventory bounce in the second quarter along with everything else. And then obviously seeing unemployment claims coming down towards 400,000. So there's a lot of improvement there. I also very much like seeing this growth in capital goods orders. So investment spending looks strong. So this is really an economy that is just growing in terms of momentum. And I think it just does pose a question: why are interest rates not higher, given how strong the economy is?
Well, David, why aren't they? Why are they at 160, 79?
It is somewhat mysterious. I mean, it seems like the fixed income markets believe the very dovish tone coming out of the Federal Reserve, but I don't know that they should believe the Federal Reserve in this, because I think when the data change, particularly when you get those higher inflation numbers, and provided the economy continues to recover through the fourth quarter of this year, I think the Fed is going to change its tune. It's going to taper a little earlier than they expect. I think it's going to raise short-term rates a little earlier than many people expect. So I do think we'll see higher long-term interest rates by the end of the year. It's just surprising we haven't seen more so far.
You just said you think they'll raise interest rates sooner than most people expect. David, when is that?
Well, I think what they're going to do is, first of all, I think they'll start tapering bond purchases at the start of next year, or maybe even in December of this year. And I think they'll have to raise the federal funds rate either at the end of 2022, maybe the December meeting in 2022, or else the January meeting in 2023. But right now, their forecasts are they don't think they're going to raise the short-term federal funds rate until 2024 at the earliest. And I think that's just not realistic, given the economy is basically going to be fully healed as far as we can see from a macroeconomic perspective by early next year, and that just doesn't justify rates at close to zero.
David, how much does the Fed policy really hinge on what type of spending plan the U.S. government decides to pass? This idea that we're looking right now under the Biden's new budget that was just released, or at least as reported by the New York Times, the total U.S. debt held by the public would rise to 117% of the size of the economy by 2031. That's what Tom was talking about earlier. Can the Fed start to taper? We're starting to talk about borrowing that much more money in the near term.
Well, they'd better, because we need to figure out how do we finance that at normal interest rates. Because for as long as you keep interest rates at close to zero, you're distorting everything in capital markets. You feed good businesses, but you allow bad businesses to stay alive. You allow speculation to run rampant. So it's very important the Federal Reserve normalizes. And if that means that the federal government has to be a little bit more picky about what it spends money on, that's probably a good thing. So I don't think the Federal Reserve should get scared by the level of the debt. Frankly, they're encouraging this growth in debt by keeping rates so low.
Well, but what are normal rates at this point? I mean, through every cycle we were talking about before, that rates have come lower and lower, and the more debt you incur, the slower growth is. So some people, including HSBC's Stephen Meager, says the natural path of interest rates of benchmark borrowing costs should be lower for the U.S. government just based on that slower growth trajectory. Why is that not the case?
Well, I don't think it should be the case. I think it's been caused by a Federal Reserve which has really flooded the economy with liquidity. And the key thing is that flooding with liquidity doesn't actually stimulate aggregate demand. And I think this is what they've missed all along. That's why, big reason why the last expansion was so slow. But what's a good level of interest rates, a normal level? It's got to be a positive long-term real interest rate. If you lend money in the long run, you should get a positive return after inflation. If you borrow money in the long run, it should be because you expect to invest in something that will generate a positive return after inflation. If you don't have an economy that's operating that way, you've got an economy that's heading in the wrong direction. And so I think at least positive real rates. So that means 10-year Treasury yields well above the rate of inflation, which, even by the Fed's measure, is close to 3% year over year, based on the numbers we're going to get tomorrow.
Dr. Kelly, I want to take your J.P. Morgan work and dovetail it with your work at Putnam years ago with the iconic Bob Goodman, who was the great optimist. And that is, in the sum of the David Kelly analysis, are you worried about the gloom of jump conditions, given what we're doing with our fiscal and monetary policy, new theories, maybe seat of the pants approach? Or do you see a smoothness where investors can say, this will work out, we'll get to the other side of the bridge?
Well, I don't lose much sleep over it, because I think it'll take a long time for any crisis to unfold if we have a crisis. But where I don't believe in modern monetary theory, I think it's nonsense. And I think in the long run, the key thing is if you run big budget deficits, and if it actually helps the economy, then this level of debt will cause the economy to blow up. It's modern monetary theory only works if it fails to actually achieve any improvement in human welfare. So it's a bad idea. I think you've got to try to get to normal interest rates. If you set interest rates at the correct level, then the economy will operate optimally.
David, always good to get your view. Don't hold back. David Kelly there of JP Morgan Asset Management, the Chief Global Strategist. Your equity market turning just a little bit higher, up 2 points on the S&P 500. Equity futures just about getting into positive territory. Yields are higher by 3 basis points on a 10-year. It's the right kind of downside surprise on jobless claims. 406 against an estimate of 425K and a previous read of 444, Tom. 406.
John, I had an entry point about 3 hours ago, and I missed it again. I mean, buy the dip here. Have either of you seen any adjustment in the tone in a great bull market of buy the dip?
No. Do you want me to elaborate?
Yeah, well, it's radio.
I haven't seen,
John, radio, you have to elaborate.
A big adjustment.
Well, I will say that even more so, you saw the Russell outperform yesterday. People are trying to go back into the cyclical story, the idea that it had underperformed for most of the month. It's coming back now.
I had such a great time with you both this morning.
Wow.
Honestly, just fantastic. Just brilliant coverage. Things got really interesting.
Is he serious?
As the show progressed.
He's not
good.
serious.
I think it's been fascinating. Folks, this is what we do. I mean, we've got a staff of 3 people helping us get through the show. And, we don't know at 5 or 6 a.m. what the news is going to be at 9 a.m. And we're literally
I'm happier
making it up as we go.
That's for sure. I'll be off.
Then when? 8:35?
When it starts. From New York City alongside Tom Keene. My good friend and colleague, Lisa Brownwood. I'm Jonathan Ferro. Equity futures are 2 on the S&P. Yields on 10s, 160.96, up 3 basis points on a 10-year yield. Alongside Tom Keene and Lisa Brownwood, I'm Jonathan Ferro. Counting it down to the opening bell. We'll continue to do that both on TV with myself, on radio with Tom Keene. From New York, on radio and TV, this is Bloomberg Surveillance.
With the first one news, I'm Ritika Gupta. President Biden will reportedly propose a $6 trillion budget on Friday that would take the United States to its highest sustained levels of federal spending since World War II, whilst running deficits above $1.3 trillion throughout the next decade. The New York Times is reporting that Biden's plan calls for the federal government to spend $6 trillion in the 2022 fiscal year and for total spending to rise to $8.2 trillion by 2031. And the Biden administration is taking steps to prevent ransomware hacks like the one that crippled Colonial Pipeline earlier this month. Directives will be issued as soon as today, requiring pipeline operators to conduct cybersecurity assessments and report any incidents to federal officials. Companies could face penalties starting at $7,000 a day if they don't comply. And British Prime Minister Boris Johnson is hitting back after his former strategist, Dominic Cummings, said he was unfit to lead the country. Whilst visiting a hospital today, Johnson said some of his comments, quote, bore no relation to reality. Johnson refused to comment when asked about Cummings' assertion that he'd said earlier that he'd rather, quote, let the bodies pile high than order a third national lockdown. And more legal trouble for Amazon. Bloomberg has learned that attorneys general from Massachusetts and Pennsylvania have joined the list of officials looking at the online retail giant for potential antitrust violations. That list had already included several states and the Federal Trade Commission. Amazon is accused of using its market power to crush rivals and vie for business against third-party merchants. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We're definitely concerned about taking off enhanced unemployment benefits too soon. Every state's going to act on its own, and obviously economic conditions differ across states. It's really helped people get through the recovery, get through the crisis to the other side, and along with the distribution of the vaccine, it's been one of the more important parts.
Jared Bernstein of the White House, that's an even more important comment made yesterday after what we've seen from Jim Tankersley at the New York Times, a stunning article on the budget view over the next decade of the Biden administration. We'll have much more on this. David Weston at 12 noon, Balance of Power, I'm sure will put this front and center. We get lucky with a gentleman from Arkansas in the 2nd Congressional District, the Republican French Hill, joins us on 4 or 5 other topics, which we discard, to talk about $6 trillion, a trillion here, a trillion there. Congressman Hill, I want you to go all Everett Dirksen on us and give me, forget about modern monetary theory, give me the modern French Hill theory about how all Americans adapt to 117% total debt of GDP 10 years out. Can we do this?
Tom, Lisa, good to be with you. We haven't seen this since the end of World War II, when America was 50% of global GDP, and that debt, way over GDP, was a result of fighting and winning a world war. Now we have embedded deficits for all the out years from our social safety net systems and by government growing as a percentage of GDP. I don't believe it's sustainable, and my biggest concerns are the potential for creating inflation, once again going back to high inflation expectations. Secondly, the value of the dollar connected to that, obviously, and the ability of servicing that debt as interest rates inevitably rise from their historically below zero level today.
Other than winning in 2022, what is the appropriate Republican response to this budget as proposed? And again, I don't mean the one-year fiscal budget, Congressman, but the idea out 10 years. What's a cogent GOP response?
Well, look, starting in 2010 to 2019, before the pandemic, as you will recall, the budget for discretionary spending was essentially flat. In fact, it declined in real terms. So Congress has the ability to control discretionary spending and better reform our mandatory spending programs like Medicare and Social Security. And we need to come back to reality after the pandemic, Tom, focus our spending, target our spending, reform our mandatory spending programs, and in my view, as a House Republican, not expand the role of government in our daily lives, which this budget does in spades.
There is a question, though, about useful spending and the idea that sometimes if you spend, you generate more growth. We saw that certainly from the 1990s and the Clinton era. We've seen this over time. If you borrow, you can actually generate a more positive future. What is the distinction between good spending and bad spending right now?
Well, first of all, I think there's a rational level of spending too much, too fast on too many things that are not rational spending. And you look at the 1990s. President Bush and President Clinton had some modest tax increases, that's true, but you also had the peace dividend as the Soviet Union unraveled, and it allowed President Clinton to work with Congress to balance the budget by the end of the decade. And they did that through reform, including mandatory spending programs and other social spending. So again, it's targeting, it's reform those programs, it's look at ways to build our country. And when it comes to infrastructure, that would be a rational spending of public money. That needs to be done in a targeted way with a principal focus on things that are really in need of repair and reform. Inflation has been an interesting debate, and that was one of the biggest arguments against running the deficit this deeply. A lot of people have come out and said they're worried about inflation. It's become a a sort of polarizing debate in Washington. How much inflation are you looking at that would be too much? I mean, are you looking at specific thresholds that would create a problem for the economy? Well, we have sharp increases in commodity prices. You look at lumber being the worst, perhaps, and Chairman Powell hopes that these are transitory. But other members of the Open Market Committee, like President Kaplan at the Dallas Bank, are concerned that if this gets out of hand, we will once again get into a 1970s inflation expectation situation, where instead of trying to cut costs and improve productivity at businesses, we just raise prices and suggest that up and down the supply chain, if we embed that, we're in trouble on inflation. If we don't, it's transitory.
French Hill, one of your charms is you actually have fairly close elections, unlike so many other people in Congress. French Hill 55%, Joyce Elliott 47% in the last go-around. Republicans are going to win in 2022. A lot of experts tell us here, you're the kind of district that's critical for them to sustain themselves to victory. Again, what do you need to do to get your district to take a more conservative stance? How do you sell that to America? Well, look, I think Americans are so rational. We operate off the kitchen table. We operate around our companies with our employees, and it's about using math and rationality. And we think borrowing money at the rate the Biden administration's proposing it and expanding government is not really a shared value by most American families. So I think it's targeting, Tom, and budget priorities, and that's what we need to be focused on as we come out of this pandemic. The Clinic. French Hill, thank you so much. Greatly appreciated from the 2nd District in Arkansas. You know, Lisa, I look at this and, you know, we catch Congressman Hill unawares there. He has not seen the New York Times article. We should make clear on that. And Lisa, what I find fascinating is all my training is fiscal matters don't matter in the voting booth. Well, and you wonder if this time is different. In other words, are people going to worry about the deficit? Yeah. Well, doesn't matter. Are they going to worry about the deficit, or are they going to worry about child care? Are they going to worry more about the programs that Biden's proposing to finance? Or are they going to worry more about the potential debasement of a dollar and potential inflationary pressures? This is the debate, right? And honestly, there is a question going forward, exactly to Congressman French Hill's point about the idea of higher servicing costs. We haven't seen that. In fact, debt servicing costs have gone down in tandem with those lower rates, even as the U.S. has incurred more debt. When does that paradigm change? David Kelly saying it needs to change sooner. A lot of people saying should doesn't really factor into this. More debt means slower growth, which means lower yields ahead. Well, and again, I revisit, say, Gary Schilling's arch call on deflation and low interest rates, and certainly many economists have pointed out that the inflationistas, as they're called, have gotten it wrong. What's so important, Lisa, in that study study is the Biden budget, as reported by Tankersley, goes back to GDP estimates, which are more conservative and cautious than the Trump boom statistics that we got, well over 3%.
And that's what we've been hearing from other people who've come on the show, other economists who say we are going to revert more to a mean 1.8% type of GDP growth rather than the 3, 4, 5% growth that people are going to see. The question is, demographics are tough, right? We're getting to be more aging population. We've got bigger programs to finance. How do you generate that inflation? I'm just throwing it out there, generally, abstractly.
It's just great that Lisa just kills it there. We will stay. We will. I can't,
hold on a second. No, I mean, you can't deny this.
There we are. We are. Folks, we're getting older. Stay tuned to Bloomberg Radio and Bloomberg Television.
Lord,
Governor Raimondo will never age. This is Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. 30 minutes away from the opening bell in New York, with equity futures just about turning positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue. Another Fed official talking about it.
Tapering.
Thinking about tapering.
Think about, talking about, planning tapering.
We're going to be sitting with that all year.
Of course, they're afraid of creating a 2013 incident.
The Fed's objective right now is managing expectations.
And the market is starting to think about the fact that in 2022, there's going to be less liquidity.
The Fed speakers over recent days have really reinforced that.
Look at President Kaplan.
Quarles, Clarida.
We're going to continue to see this debate.
Tapering discussions, they're only heating up.
We, as well as many others, are looking towards the Jackson Hole Symposium.
The Fed's buying $120 billion worth of bonds a month.
Overly accommodative.
It's really hard to argue the markets need that still.
Investors are going to have to probably look to Jackson Hole.
Looking ahead to Jackson Hole, a couple of months away. Let's bring in Clear Harbour's Aaron Kennan. Jim Bianco of Bianco Research with us as well. And Jim, I think we've got to start with the bond market. Your 10-year yield at 160, up 2-3 basis points on the session. In the face of this conversation that's playing out right before us, in the face of a conversation about deficits north of $1 trillion for the foreseeable future, what are we doing down here at 160?
Oh, I think the market is just kind of staging for another move higher in rates. Look, we were at 50 basis points a year ago. It's been a generation since we've seen inflation. If you're under the age of maybe 60, you don't remember what inflation was. And don't forget that the first quarter was the worst total return quarter for the bond market in 40 years. So I'm not surprised that we're doing a little bit of congestion here. And I agree with your implication that rates should be going higher with these giant deficits, with all the stimulus that's coming. Patience, grasshopper, they will be going higher.
Aaron Kennan, do we need patience?
Well, you know, we haven't moved since March 31st. The average 10-year Treasury yield's 161, and that's almost exactly where we are this morning. I think the market is trying to figure out what the Fed's going to do, but the Fed is also peering ahead, John, and looking at the economic forecast for 2022 and 2023. And the reality is we're going to see robust growth this year, call it 6.5%. Next year, it's going to probably have a 4 handle on it. And the year after that, it's probably going to move back towards the secular growth of call it 2%. And I think that's the real debate right now that the market should be having. How does the Fed not only taper, but raise rates in 2023 and beyond in the midst of a significant decline in economic activity?
This is an important transition. We're going to decelerate, Jim, into next year, maybe a 4 handle in Aaron's mind, and from there maybe down towards 2. For the bond market, how do you think we need to digest that?
Well, I think the bond market needs to kind of figure out where stimulus is going to come from here. Yes, we've stimulated the economy to a 6 handle. Let's say we don't get inflation. I think the calls that we're going to ratchet up more stimulus in 22 and 23 will grow much larger, and we'll probably see some stimulus in 22, 23, absence any kind of impediment like inflation. So it's still very uncertain which way the economy is going to go. Now, yes, I agree. If we get no more stimulus, we're going to see 4 and then 2. But that's a big assumption that there's going to be no more stimulus coming after this year.
Well, here's the reporting from the New York Times this morning. The lead quote, President Biden will propose a $6 trillion budget on Friday that would take the United States to its highest sustained levels of federal spending since World War II, while running deficits above $1.3 trillion throughout the next decade. For more, let's bring in Mike McKee. Morning, Mike.
Good morning, John. Well, we're supposed to get the budget tomorrow. The New York Times apparently seeing a copy of much of it earlier and reporting, as you mentioned, a $6 trillion spending plan for next year. That is about $1 trillion more than we spent this year with the pandemic recovery. And so, as you can see there, debt as a percentage of GDP rises significantly over the years, according to the budget document. Now, those are projections by the Congressional Budget Office. They say we'd go from where we were a year ago, about $101 trillion to about $117 trillion in debt held by the public. Here's the spending number that they're talking about, and you can see the magnitude of the increase. This is for his Build Back Better plan, which has 2 components. One is the American tax plan, which would, in theory, pay for some of this, and the other is the American social plan and the American jobs plan. I forgot there were 3 parts to this whole thing. So the New York Times reporting that we're going to have a lot more debt as the president tries to spend, and that means more taxes. Taxes as a share of federal GDP are also going to rise significantly. Now, the economic projections that they're making are very, very conservative. Take a look at this. Although we get a spike in growth in the next year or two. Over the next 10 years, it would average about 2%. Unemployment would fall below 4% next year and stay around that level. CPI inflation, a high of about 2.3%. So very conservative projections for an awful lot of spending. And I bet they are actually thinking they're going to get much more than that. They say, John, president proposes, Congress disposes. But remember, this president has a Democratic Congress.
Well,
so
we have a counteroffer from Republicans right now, Mike. So let's go through these headlines. A counteroffer from the Republicans on infrastructure, seeking about $928 billion in infrastructure spending. The GOP offer includes $257 billion more than already planned in infrastructure funds. The plan focuses on roads, bridges, broadband, and airports. And Mike, clearly, there's still disagreement over the scope of this bill and the definition of infrastructure.
Well, we have to go underneath the hood and look at where the money comes from, because the Republicans have been proposing using a lot of money that's already in the rescue package that was already passed, that $1.6 trillion package, and the president wants new money for this. So that's still a big point of disagreement.
I think we've got Emily Wilkins down in Washington, D.C., standing by for us. So let's get down to Emily down in D.C. to get the latest of this. A counteroffer, Emily, from the Republicans.
Yes, we're expected to see more details about exactly what this counteroffer looks like. Some things we do know, it's expected to be in the $1 trillion range, and it's supposed to continue to focus on traditional infrastructure, roads, bridges, things that Republicans have been pushing for all along. You know, you've seen President Biden and Senate Republicans come closer together on what the top line spending number would be for this bill, but there are still a number of details that they've yet to work out, including how to pay for it. And time is really of the essence here. You've heard both Republicans and Biden say that they'd like to get an agreement on this by Memorial Day, obviously coming up very quickly. President Biden is under pressure from his own party to really move this along, even if that means that Democrats have to go at it alone.
Emily, let's touch base again in a couple of minutes' time as we go through some of these headlines. I want to bring in Aaron Cannon and Jim Bianco. Aaron, it's a theme of this program over the last couple of weeks. What to expect down in D.C., how to establish a base case. At the start of the year, it was more. It was even more after Georgia. What is it now?
Well, Jonathan, after the August recess, we're going to be moving into the election season. And I think we all know that it's challenging to move anything through Congress during that cycle. So it's sort of now or never. I do think the focus on roads, bridges, and 5G makes sense from an economic perspective. I think the one hope for economic growth moving above that 2% trend level, like we had mentioned earlier in the conversation, is productivity. And if we can increase productivity, that's great. But on the other side, as Mike just pointed out, we have rising debt to GDP. That's a headwind to secular long-term growth trends. And we have an aging worker population and a deceleration in the overall population. So there are some real headwinds, but productivity in the intersection of that with the infrastructure bill is a sign of hope.
Aaron, traditionally, everything you had just described previous to what you just said at the end there is bullish for bonds. Does that change?
Well, I just go back to, what I think, where I think monetary policy should be is irrelevant. What I believe is looking at the dial of fixed income, which is 2 years are at 14, 15 basis points and 10s are at 160. And what is that telling us? It's telling us the curve's steep. It's getting steeper. The economic picture is strong right now. As curve flattens, perhaps in 2023, it means economic activity is going to decelerate. But in the front end of the curve, nothing has been moving for many, many weeks, if not months. And that's telling us the Fed's going to remain on hold because they're mindful that future economic trends are not going to be the sort of robust picture that we're looking at today.
Jim Bianco, what's your take?
I think it really comes down to the inflation outlook right now and whether or not we're going to see more inflation or not see more inflation. I believe that we are going to see more inflation. I think a lot of the indicators, whether it's commodity prices or even the strengthening yuan, are telling you that inflation is coming. It's here now, or maybe it's better described as it's not going to recede as much as everybody thinks, and that the narrative will change in the second half of the year towards getting away from the word transitory, and that all this kind of conventional wisdom that the Fed is going to announce a change at Jackson Hole and a taper in the first quarter, I think might be sped up, if anything else, then slowed down, given where I think the inflation data is going to head to.
So, Jim, I know so many people are so bored of having this conversation. Do you think it takes until the end of the year really to draw a line underneath of it one way or the other?
Yeah, I do think it does, because right now, if you want to be honest about the Fed, they're not data dependent anymore. They're really calendar dependent. They're really putting everything on a calendar. That's why we talk about Jackson Hole in next year. And really what we're going to discuss in the next couple of months is adjusting the calendar. Maybe the data will be the reason we adjust it, but we're really going to be just talking about time as opposed to talking about growth in the economy. Because it seems all roads are that they want to start to taper, and I think that the risk is that that's going to come sooner than everybody thinks and not later.
Jim Bianco, Aaron Cannon sticking with us. Equity futures up around 0.12% on the S&P 500. At the market desk, here's Abby.
John, we start with some breaking news because just moments ago, GM announced that they will be restarting 5 plants that had been closed on the chip shortage. So this is a sign that the U.S.'s largest automaker is managing through this crisis. They're restarting 2 plants in Mexico, 1 in the U.S., 1 in Canada, and another in South Korea. It does definitely put the company in a more stable position after this chip crisis. And you can see the stock is responding well, up 2.7%. Before this headline, it had been up just a little bit. So again, GM is restarting 5 plants that had been closed due to the chip shortage, and investors are responding well. Where we have a little bit of weakness, though, is tech. And this, of course, has everything to do with the rate story. Apple, Microsoft, Amazon, Alphabet, all trading lower. Not big losses, John, but just a little bit lower as those valuation, those inflation pressures take tech down just a little bit. But up until today, we had the NASDAQ at least higher 3 days in a row. And then finally, with those rising rates, what sector is responding well? Not surprisingly, the big banks. Lots of strength for the big banks. So it's all about rates again, John. But today, the reflation trade is in charge.
Abby, thank you. JP Morgan up another 1% or so. Coming up on the program, Senate Republicans pitching their latest infrastructure counter proposal. That conversation coming up next with Aaron Cannon and Jim Bianco from New York. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
One of the things that I'd like to see is I'd like to see us expand infrastructure. I know Republicans say let's keep it to the hard concrete issues, and I'm not against that. I think you can get to $1 trillion by having some simple permitting and regulatory reforms that maintain the integrity of our environmental excellence, while at the same time unleashing the private sector investment.
That was Senator Kevin Cramer there of North Dakota on the infrastructure spending plan. We have a counteroffer from the Republicans. They introduced a bill that totals $928 billion, most of which was expected to be enacted anyway. The release listed net new spending of at least $257 billion. This news breaking in about the last 10 minutes. Let's bring in Bloomberg's Emily Wilkins in D.C. for more. Morning, Emily.
Morning. So as we speak right now, Republican senators are continuing to roll out the details of their new plan. And of course, the big question is today, how will the White House respond? Is this something that President Biden feels that he can continue working with and making progress with? Or is this going to signal an end of the road for the current infrastructure talks and have Democrats try and figure out a way for them to go it alone? A couple notes on this proposal. We are seeing a lot of the so-called traditional infrastructure spending being proposed. Roads, highways, bridges, public transportation. What we're seeing elements missing of, and things the White House has been very insistent on, are sort of more of those more green energy initiatives, things for electric cars. And there's still a big question of exactly how senators are going to propose to pay for this. We've seen a lot of conflict on that particular point. President Biden wants to raise the corporate tax. Republican senators have said absolutely not, no way. They've proposed user fees. Biden said absolutely not. There have been a couple options on the table, but at this point, it's not exactly clear how this would be paid for. And that here in D.C. is always a huge sticking point and enough to really sink any proposal.
From where I'm sitting, Emily, it doesn't feel like we moved the dial that much with this particular counteroffer. Would I be right? Is that a fair characterization of things, how they're playing out right now?
I mean, yes, you did see Senate Republicans come up in what they are offering, but you didn't see them go, A, as far as the Biden administration, and B, they are still $700 billion apart, and that's no small thing there. And the other thing is the timing element of it. Progressives are really putting pressure on President Biden as well as leaders in the House and Senate saying, hey, you know, we need to get moving on this. We not only have to pass this legislation, but we want it to be implemented well before the November 2022 election. We want shovels and grounds. We want projects underway. And so there is a lot of pressure right now that if these negotiations do not come together soon, that Democrats are just going to have to go it alone.
Emily, I'm not singling out a particular party here. This applies to both the Democrats and to the Republicans. Are we negotiating here or campaigning?
A little bit of both. I mean, you're never not really campaigning when you are a lawmaker. But look, for these senators, a lot of them, they're not facing re-election anytime soon. I think there is a genuine interest to get something done in a bipartisan manner. It's what President Biden campaigned on. He's already seen Republicans ding him on it for having not done so for the COVID spending package. There is a good faith effort here. And there's also a plan B going on. We heard reports yesterday that a group of senators, including Democrat Joe Manchin, as well as Republican Mitt Romney, are a part of a group trying to see if they can come up with their own bipartisan infrastructure plan should discussions between the White House and Senate Republicans fail. So there's even a potential backup here, but once again, it's really all comes down to a matter of timing. Democrats do not want to repeat their previous mistakes with the Affordable Care Act, spending months and months and months on negotiations, only to not have a single Republican vote for the ultimate bill.
Emily Wilkins down in D.C., Clear Harbor's Aaron Cannon back with us, Jim Bianco of Bianco Research with us as well. Jim, you know the trade, you're familiar with it, the cyclical trade, the commodity story, all of the above, energy, etc. How important a piece of the puzzle is the negotiations around infrastructure to make sure that plays out into year-end and beyond?
Oh, I think it is important. I mean, just what Emily just said, look, we're at $1 trillion floor right now, and we're talking about going higher. That's a lot more stimulus. That's a lot more money that's going to be used to buy commodities, that's going to be to buy finished products, that is going to put, I think, upward pressure not only on prices, but also on the economy too, and eventually on interest rates. So that's why you see the bond market react to these kind of budget negotiations more than they have in previous years, because these numbers are so big and they are impacting the growth outlook and the assumptions that everybody uses when trying to gauge the fair value of interest rates.
So, Aaron, is this another reason to stick with the cyclical trade?
Yes, it's one reason. I think the larger is the reopening story. I mean, we've had it here in the U.S. It's quite robust. There's a delay in Europe. Now we're seeing really nice growth coming out of Europe. European equities have responded to that, forward-looking, discounting forward-looking. Projections there in Europe look very strong. Global growth for next year looks very strong. Southeast Asian growth looks strong. I think that's the cyclical story. I don't think $1 trillion infrastructure bill is the big story for for the cyclical story. I think if you believe the cyclical story is going to continue, you have to believe that global demand is going to be extraordinarily robust over the next year or two.
Aaron, the key variable in what happens here in the US economy is what happens with that pile of savings, that savings rate. We know how much is sitting there. The unknown, Aaron, is how it gets spent, the degree to which it gets spent and where it gets spent. Do you have any idea of what that looks like from here through year end into 22?
Well, we just saw some really interesting earnings coming out of, sort of the retail sector over the last 24 to 48 hours. Very strong numbers. And so I think that's the trend line. There's been a lot of noise because, of course, we had the unemployment bonuses that still haven't really dissipated yet. So there's been a lot of noise in the employment data, as we have all seen. But I think the general trend is very positive there. Some children are still not back at school. Mothers and fathers have had to stay home. A lot of noise in that data, but I think that's going to sort itself out in the quarters ahead.
Jim Bianco, this is the challenge that economists have got right now. We know what the savings rate is. We know how much money is sitting there. We've got a rough idea. We just don't know how much of that's going to get spent.
Yeah, that's right. And it really, I think, comes down to a lot of confidence. You're right. The savings rate is at 22% right now. And it's considered to be a number that was inconceivable just 2 years ago to see it that high. But we are starting to see signs, as Aaron pointed out, that it is getting spent in a lot of ways and in a lot of different places. And one of them might also be in the labor market, too. I think a lot of the big miss in the employment report last month was because workers want higher wages to come back to work. They've got enough money right now that they can just sit around and wait for that, and companies are starting to respond by raising wages. So we could see a specter of wage inflation on top of everything, too. But to your point, that savings rate and what happens with it is going to be a big issue. Right now, a lot of it's in the stock market, and we'll have to see how much of that actually comes out of the stock market as people get confidence and start spending it.
The next couple of months is going to be absolutely fascinating. Aaron Cannon, just a final word from you. Final question, conviction trade going deeper into summer. What is it now?
Oh, gosh, that's a great question. I think we look at the forward, estimates for earnings. We are, quite positive on that. But, for us, it's about 19 times. So we think, the market's not extraordinarily expensive here in the U.S. We think the European equity trends look quite positive. And we think, we want to be a little more shy on China. But certainly non-China EM looks quite interesting, where longer-term growth trends there will most likely continue and start to outpace the U.S. and developed world, which hasn't happened over the last couple of quarters. So that's certainly one trend that we're keeping our eye on.
Aaron Cannon, appreciate your time, as always, alongside Jim Bianco. And Aaron, happy birthday, too. I understand you are the birthday boy today. So happy birthday, sir, and thanks for spending some of it with us. Thank you. Equity futures up 0.2%. Up next, your morning calls from New York. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
About 5 minutes away from the opening bell in New York City. Equity futures doing okay, up about 0.2% on the S&P 500. Slightly negative on the Nasdaq, down 0.1%. You switch up the board and get to the bond market. It was a total snooze a little bit earlier this morning in the bond market, well south of 160, starting to build back up. The right kind of downside surprise on initial jobless claims. Your 10-year right now, 160.28, and up 3 basis points. That's the price action. Who are the morning calls? Some of the analyst action this morning. RBC upgrading Ford to an outperform with a street high $17 price target. The analyst seeing a credible path to increasing profitability. We're up 3.6% there. Stevens upgrading Chipotle to overweight, $1,700 price target. The analyst cited the stock's attractive valuation and position sales growth potential. And finally, Goldman Sachs upgrading Occidental to a buy, $31 price target. The analyst highlighting the company's improving balance sheet and low carbon initiatives. We're up there by 1.86%. Coming up, big changes for big oil. Shareholders delivering Exxon and Chevron some stunning defeats. That conversation next with Katie Kaminsky of Alpha Simplex and Keith Lerner of Truist.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 24 seconds away from the opening bell in New York City this Thursday morning. Good morning to you. Equity futures look like this on the S&P, advancing through 4,200 again, up 11, 12 points, up about 1/3%. We advanced just a little bit. The Nasdaq a bit softer through much of this morning. There's your opening bell. Here's the bond market. Your 10-year yield shaping up as follows. South of 160 at the start of today. Yields now north of 160 at 160.45 and up 2 or 3 basis points on the day. In the FX market, euros slightly negative, south of 122 at 121.86, and totally unchanged on crude, $66 and about 20 cents. That's the cross-asset story this Thursday at the market desk. Here's Abby.
John, let's start out with stories, news on the car makers. And of course, earlier this hour, GM, there was breaking news on the fact that they are restarting 5 plants that had been shut for the chip shortage. The stock responding extremely well, a sign of stabilization for the company. And meanwhile, Ford, of course, on all of their EV plans, the stock has been much higher recently. And today, too, this is RBC has upgraded shares to an outperform, plus other banks are bullish as well. But today, it's really all about rates. We have yields climbing in part on the New York Times report that the Biden administration is proposing a $6 trillion budget for 2022. That has rates higher. Even so, at this point, Apple trying to gain, Microsoft lower. Earlier, tech had been down under that valuation pressure, that possibility of inflation. Banks are higher, although Morgan Stanley right now unchanged, and betting that will open higher with yields moving up. And there we go. Morgan Stanley up 0.9%. And then finally, John, another piece of the reflation trade, energy, big energy. We have mixed moves at this point, despite the fact that oil is about flat. Of course, the possibility of that deal with Iran, extra supply hitting the markets, but investors looking past that right now, John.
Abby, thank you. Chevron up about 1/3% this morning. The CEO, Mike Wirth, saying climate change is a key focus for the energy industry. He spoke to Bloomberg exclusively.
Investors of all types are focused on this as we are, and so that's part of it's part of the environment today for companies that are providers of energy, and I believe our industry is part of the solution. We have the technical capability, the project management capability, the engineering acumen, and the financial capacity to be part of the solution.
It has been a tough 24 hours. On that story, here's Bloomberg's Caddy Lines. Hey, Kaylee.
Hey, John. Well, Mike Wirth really just reading the writing on the wall here in that the tide is shifting for big oil. Chevron, Mike Wirth's company, yesterday losing a shareholder vote, investors backing a climate proposal to reduce emissions from the company's customers, plus Royal Dutch Shell losing a court case in the Netherlands. It was ordered to slash emissions harder and faster than originally planned. And who would have seen this one coming? A tiny first-time activist investor with a 0.02% stake in ExxonMobil gets into the ring with the oil giant and wins the fight. Engine number one winning 2 board seats for Exxon, and it has promised to push the company to diversify beyond oil and fight climate change. So big oil is facing a real ESG reckoning here, John. But even amid that reckoning, this equity market is unfazed. Energy stocks continue to outpace the broader S&P 500 yesterday amid all of this, and they are still the best performing sector within the broader index on a year-to-date basis, up about 37%. Because even if there is pressure on the climate front, there are still a lot of macro factors working in big oil's favor. And that is that we are emerging from the pandemic, the world is reopening, and that means more cars on the road, more planes in the air, cruise ships setting sail once again. All of that takes fuel. That means more demand, and that the prices for big oil's products are moving higher, John.
Kelly, thank you. Joining us now is Katie Kaminsky of Alpha Simplex and Keith Lerner of Truist. On this conversation, Katie, let's start off with you. Energy's been a big piece of the cyclical trade for so many people. Do you want to stick with that trade now?
Yes, I think this is going to continue, because if you think about where we are now, demand is going to continue to tick up. I know we've had a couple of setbacks recently related to supply, but our signals are definitely still very strong, long oil, and sort of in some sense saying that the oil trend is going to continue as the reopening trend continues.
What about you, Keith?
Yes, well, first of all, Jonathan, good, happy Thursday. But we are bullish on the energy sector. We are overweight the energy sector, and I think this speaks to a lot of the secular challenges, that oil faces. But short term, we have to remember that over the last 3 years, the energy sector has underperformed the S&P by about 80%. The percentage of the S&P as a whole for the energy sector is now 2 or 3%. So what that means, Jonathan, is this isn't a surprise. Investors already have very depressed expectations, and as the economy continues to reopen.
Cross asset, joining the line, so to speak. You touch on FX quite a lot when you talk about energy. Many people do. How does that fit into the puzzle here?
Well, the truth is there's been a very strong cross-asset trade, this reflation trade that just keeps coming back. I mean, we're seeing it right now. The dollar's weakening recently. It did come back a little bit a couple of days ago, but today, again, we're seeing it down again. There's definitely an oversupply. Comments about spending is, again, going to push the dollar weaker, which is then going to look favorable for oil as well. So in general, that particular cross-asset theme, long equities, long commodities, short the U.S. dollar, just keeps coming back. And I think that's sort of the prevailing reopening, reflation, and, you know, back to normal new world order that we're going into as we see that unfold.
Katie, if we bring up a chart of what's happening in the FX market, dollar yen snooze, euro dollar in and around 122. Over the last year, we've seen a big move in dollar China. A year ago today, that currency pair topped out. We've gone from a 7 handle to a 6 handle. Chinese currency strength. Katie, how important is that just in this conversation at the moment?
It's very important because if you think about what that means, those are the purchasing powers of those two big economies. And when you have commodity prices moving where they are as well, that also comes into play. And then you might start asking yourself the question, at what point does the Bank of China start saying, do we need to devalue our currency to catch up with the US dollar? So right now we're really at a very extreme situation where the dollar is very much in oversupply and it's become much weaker, which is going to create a very different trade dynamics, very different purchasing dynamics, and change asset class flows going forward. So I think it's a very critical point in that sense that it puts, you know, puts that into question.
The PBOC coming out with some pretty calm language this morning about the need not to do the above, which is either devalue the currency, depreciate it too much, or strengthen it too much, either for any particular gain for the country. Keith Lerner, you've got a dollar call here, a base case into year end?
We have a very boring call, at least so far this year, which is stability. The Dixie, as of yesterday, year to date, it was up 0.05. So it's been pretty stable for as a whole. And I do think you could see a little bit of upside in the euro in the second half, but somewhat modest, because if the euro gets too strong, that's not going to be great for their economy, which is export dependent. So maybe a little bit of weakness, but we're not as bearish as the street, nor have we been this year. We've been looking for stability.
Keith, I'm going through some of the calls over at Truist. Overweight financials, materials, energy. You'll forgive me, but we've all been talking about that. We've seen that so many times. Underweight, utilities, healthcare, consumer staples, and this is the one that jumps out. Consumer discretionary, a recent downgrade. Why, Keith?
Well, first of all, you're right. I mean, we're overweight these sectors, but we have been overweight most of this year, those same sectors. It has become a consensus call, but also realize, you know, the growth style has outperformed for about 14 years. So some of these sectors still have upside. Specifically, to your question about discretionary, you know, discretionary is a bit of an odd sector because when you look at it, even though it benefits in some ways from the reopening trade, it's really a quasi tech play with two of the biggest names in that index, really more growth oriented. And in our view, technology is not leadership. We've seen a little bit of a bounce from an oversold level. We would look to fade that bounce and move more into the cyclicals. And one more point, Jonathan, on the financials. You know, the financials had a big run. They're consolidating here short term, but they just moved above where they were in 2007 and been compounding at a rate of about only 1% over the last 13 or 14 years. So we still think there's upside there as well.
We'll add to the banks conversation. We'll build on that in just a moment. Keith Lerner, Katie Kaminsky sticking with us. Let's head back to the market desk. 9 minutes into the session. Here's Abby.
And it's interesting, John, because we're looking at the first down day for the NASDAQ 100 in 4 days. So big tech, the mega caps, really taking a little bit of a breather today. And we do have two earnings movers that are also weighing, NVIDIA and Workday. NVIDIA, despite the fact that they put up a strong quarter beating, they also offered a strong forecast. Gaming and data centers doing well. The stock is down 0.5%. And Workday, they really beat. They boosted also, but the stock is lower as well. This could have something to do with the bigger story in the day, which is, of course, rates rising, so that valuation pressure may be taking these stocks down, or maybe folks just wanted more out of those quarters, and that wouldn't be surprisingly based on what we saw out of the mega cap techs earlier this year, putting up amazing quarters and the stock selling off. As for the meme stocks, we have some weakness here after AMC climbed 53% in 3 days. GameStop had been up more than 30% in 5 days. We're seeing these short squeeze stocks taking a bit of a breather. And then on that theme of tech lower, we do have tech down just actually reversing higher once again, up just a little bit. Not moments ago, Apple and Tesla and Google and Amazon, the worst drags on the S&P 500, now up just a little bit, but you can see the real strength, John, the reflation trade, the banks, as rates rise and the yield curve steepens. Bank investors and traders like it.
Abby, thank you. Coming up, bank CEOs gearing up for a second day of grilling on Capitol Hill. That conversation ahead with Katie Kaminsky of Alpha Simplex and Keith Lerner of Truist. Your equity market positive 1/3% on the S&P 500. From New York, this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Get this economy back to its primacy, which it is on the way for.
The U.S. is poised for a strong recovery.
We're going to have a very strong economy. We're going to have it this year. It can easily go into next year and maybe even 2023.
While we're very encouraged to be seeing signs of improvement, we realize that not all of our communities are benefiting equally in the recovery.
We can return capital to our shareholders to help them enhance their returns at the same time running a small business.
We will harness the full power of our bank's capabilities to extend our reach and help make sure the recovery leaves no one behind.
Big bank CEOs facing a grilling in D.C. Senator Elizabeth Warren zeroing in on JP Morgan Chief Executive Jamie Dimon.
You and your colleagues come in today to talk about how you stepped up and took care of customers during the pandemic. And it's a bunch of baloney.
For more, let's bring in Bloomberg's Wall Street correspondent, Shonali Basak. Morning, Shonali.
Good morning, John. Certainly, the hearing was tense at moments. And when I talk to my sources close to the bankers, they all say that they feel that they've been thrown in the middle of a political football. Today, we'll hear them at the House as well. There are more people to answer to there. They're expecting more questions out of left fields, though there are some themes that are in common. That is access to credit across the economy. It is diversity, especially racial diversity among the top ranks of these banks. We've seen them specifically be grilled also on minimum wage, which we expect to come up once again, and the disparity between CEO pay and the rest of their staff. There were also questions about U.S. competitiveness. There were questions about China, Russia, Saudi Arabia, and the U.S. debt levels. So there are broader macro themes that these CEOs can answer to. But again, they're all going to be facing a new regulatory regime under the Biden administration. So the tone from the Democrats and Sherrod Brown's tone was that Wall Street is on watch will be the important tone to watch out for.
Shonali, the exchange between Senator Warren and Jamie Dimon of JP Morgan, the chief executive, has been played just about every way. You didn't see it just then.
Right.
But we've all heard it. I saw it on CNN. I've seen it on other financial networks. I've seen it on this one as well. Right. Does any of this stick? Or is this just a little snippet for Senator Warren to put in the campaign for whenever she has to campaign next?
I've been asking about this. It's certainly a lot of money at stake there, and there's a question about how realistic it is to change the rules around overdraft fees and other hidden fees. This is something I know I'll be watching from the CFPB, which is an agency that she really helped create. There's a lot of concerns about debt collection across all the banks, and it doesn't span just to JP Morgan. I would point out that Jamie Dimon did dispute her math on that, but then we are going to want to look out for what the math really is.
Shonali, thank you. Still with us, Keith Lerner of Truist, Katie Kaminsky of Alpha Simplex with us too. Keith, the regulatory environment for the financials, is it going to get worse from here?
Yeah, it may on the margin, but I will say it's kind of like what we talked about with the energy trade. The financials as a whole are reacting to this reopening of the economy. And we've had a little bit of a pullback in yields, and we're seeing that yields move higher today. You're seeing the financials move higher in the pre-open. And as long as that economy continues to move forward and grow above trend and yields move up, which is our base case, that we think financials should still do well and outperform. And also, they're trading as one of the cheapest sectors in the market. So some of that regulatory uncertainty is priced in our view.
Well, let's get to the bond yield piece of this. Katie, your base case, the 2 years pinned to the floor. The only real flexibilities at the long end at the moment. Are you anticipating a steeper curve from here?
Yes, definitely. And what we've seen this year, I think the biggest theme that I've been watching the most closely is just short signals in bonds. And I think that has been an indication that the market expects at some point we're definitely going to see more steepening. And those signals just haven't dissipated, even though things looked better. Now that we're going to have some talks coming up in June to talk about potentially tapering, and then there's also questions about more spending, all of these signs lead to inflation. Yet the Fed is also still saying this will be transitory. So from my perspective, the market is a lot more concerned than the Fed, and people are worried. They think, okay, some of this has to eventually turn into inflation. And where do we look? We look at the bond markets, we look at steepening, and we're starting to expect it.
When do you see the worry? Where do you see the worry in this bond market at the moment, though, Katie? I look at a 10-year right now, just north of 160. We were at 170, north of 170 at the end of March. That's where we peaked. As Aaron Cannon pointed out from Clear Harbor earlier on in the program, we've been pretty much around 160 now for a while. The average since we topped out at the end of March was about 161, 162. That's where we are. 2s10s topped out around a similar time. 2s10s topping out at 157 basis points. They're at 146 at the moment. Katie, these stories, we're all aware of them. Tapering, the evolution of the language over at the Federal Reserve, more fiscal money, more fiscal stimulus is coming, and yet here we are. Why?
Well, it's going to take time. We have to see more numbers. I think that's exactly the point that the Fed is saying as well, is they're saying, we think this is transitory. So once you start seeing that it's not transitory, then the game is going to change. Once we start to see that maybe inflation starts moving a little bit more than they would like, and few people worry it might be overheated, then you're going to start seeing people say, oh, well, maybe bond yields will go higher, and maybe we will see some tapering. And I think that's kind of what we're expecting, is that we need to see more evidence that the opening is going to be slower and more full of frictions and more difficult with supply and other issues with the job market than what people are expecting. And if that happens, then we'll start to see yields moving in that direction.
What about you, Keith?
Yeah, I think context is really important, John. Let's think about it. So since last August, we went from about 50 bips to 175. We did a study back then, our fixed income group, and we looked at when yields move that quickly, they tend to take a pause afterwards. And what we've done more recently with our portfolios, we shorten duration based on that. I'll also say, yes, we've moved back to 160, but when you see the equity market sell-off days, yields aren't really moving much lower. So we think the underlying move is still higher, obviously at a much more gradual pace. And I would say probably the biggest reason why we think yields still move higher is in the second half, we're likely finally, hopefully, Jonathan, to see more of that synchronized global recovery, which we have not seen up until this point.
Okay, so let's wrap things up. Conviction trades from you both. Katie, first to you.
I'd say steeper curve coming up. I'd say a lot of focus on jobless claims. I think a lot of focus on whether or not the economy is recovering. So somewhat positive on equities, but a little bit concerned about the long end of the curve.
Keith Lerner, what about you?
Yeah, I would stick with financials as a catch-up trade. We like REITs, which is underappreciated as far as the transformation in that index. They've really underperformed. So I would look there. And then also the equal-weighted S&P, we get more exposure across the market, not so top-heavy with the three ideas that we have.
Up more than 17% year to date on the equal weight S&P 500 against the market cap weighted S&P up more than 11. Keith, good to catch up, sir. Keith Lerner of Truist. Katie Kaminsky. Katie, thank you, as always, joining us from Alpha Simplex. Your S&P 500 up a third of 1%. On the S&P, we advanced by 0.28%, about 21 minutes into the session. Breaking down a sector price action is our stocks editor, Dave Wilson. Morning, Dave.
Good morning, John. Keith Lerner mentioning financial stocks. They're among the best performers of the day in the S&P 500. You look at the 11 main industry groups, you see it's really kind of an economic theme. Industrial stocks, the commodity producers, energy and raw materials, and the groups tied into big tech, trailing the pack. Technology specifically, also communication services with Google's owner Alphabet and Facebook, among others, and the consumer discretionary category where you find Amazon and Tesla. But within discretionary, it's worth taking a closer look at retail because this is really kind of the last day of first quarter earnings season for the S&P 500 retailers. You had the results today out of Dollar General, Dollar Tree, and Best Buy. After the close, we'll get numbers from Gap and Ulta Beauty. And you can see, the S&P 500 retailing index actually set a record going into the start of earnings season, and it's kind of pulled back a bit. A lot of cases where companies have been well above what analysts were looking for in terms of earnings and revenue, and yet their shares have not really responded. And that's reflected across the group as well. We're seeing some of that today in retailers too.
Dave Wilson, our stocks editor. Dave, always great to catch up, sir. Thank you. 22 minutes into the equity session, stocks advancing just a little bit on the S&P. Elsewhere in the bond market, 10-year yields up 3 or 4 basis points. Your 10-year at 161. Your 30-year up 3 basis points to 229. Coming up on the program, the market moving events you need to be watching. That'll be next in our trading diary as we race towards a long weekend stateside. A beautiful morning in New York, up 13 on the S&P, advancing 0.3% and nicely through 4,200 on the S&P 500. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
precise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Bruce.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
"25 minutes into the session this Thursday morning. Good morning to you all. Your equity market up a third of 1% on the S&P. On the Russell up 0.7%. Just a little bit lighter, lower on the Nasdaq. Down a little bit more than 0.1% as yields on a 10-year start to break out this morning at around 156, 157. Then we had the right kind of downside surprise on jobless claims. Talk of a big budget coming from the president and yields back through 160 to the upside. This morning, yields advancing, equities advancing just a little bit. That's the price action. Here's the trading diary. The events to watch through the rest of this week into the weekend. Pending home sales coming up at the top of the hour. Wall Street CEOs returning to the Hill at noon Eastern. I bet they can't wait for that again. The Treasury selling $62 billion in the dreaded 7-year note after a really choppy couple of auctions over the last several months for that particular maturity. And then President Biden delivering remarks on the economy this afternoon. That is one to watch. The tone and the content as the Republicans come back with a counteroffer on infrastructure that doesn't contain too much new money. Finally, closing out the week with U.S. personal income and spending numbers before the long weekend stateside and in many places worldwide. From New York City, this was the Countdown to the Open. Continue the conversation on Twitter at Faro TV. From New York, this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jivansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jivansati.com, where Anshu and Sumit met, is one of the biggest players. Young